Eventually, you're going to have to read it too.
Yep.
This next paper. We're going to try and move it very quickly now. Finally, so maybe by the, but I got to get it. It's got a little econometric model in the middle of it. My statistics is about 30 years old, and it has advanced dramatically in the last 30 years. So I have to get someone to.
I wanted to introduce myself. I'm Richard Capers, professor.
Mark Cooper.
Good to meet you.
Richard Peterbread.
I'm on the second panel.
Yes. Yes. Well, I salute to your
Mic check, test 1, 2.
Very much for being here. The Domestic Policy Subcommittee of the Oversight and Government Reform Committee will now come to order. Today's hearing is the first of several Domestic Policy Subcommittee hearings on the topic of the $54 billion loan guarantee program for a new wave of nuclear power plants. Today, the subcommittee will hear from non-governmental proponents and critics of the federal loan guarantee program. Without objection, the chair and ranking member will have 5 minutes to make opening statements, followed by opening statements not to exceed 3 minutes by any other member who seeks recognition. And without objection, members and witnesses may have 5 legislative days to submit a written statement or extraneous materials for the record. American taxpayers have very recent experience with the cost of bailing out businesses. Today's hearing evaluates the likelihood that taxpayers will be saddled with a new bailout. This time the bailout would be for the nuclear power industry. During the 1970s and 1980s, economics halted the spread of the nuclear power industry. Cost overruns in building nuclear power plants averaged more than 200%. Utilities abandoned 100 plants during construction, around half the plants they had planned. Taxpayers and ratepayers reimbursed utilities for most of the more than $40 billion cost of these abandoned plants. Ratepayers bore well over $200 billion in cost overruns for completed nuclear plants. In 1985, Forbes magazine called this, quote, the largest managerial disaster in business history, a disaster on a monumental scale, unquote. Now the nuclear industry wants to have a renaissance. They assert that new technologies and standardized plant designs will produce results that are totally different from their prior history of mismanagement, cost overruns, and taxpayer or ratepayer bailouts. They say that the cost of plant construction will be lower, that there will be no cost escalations or construction delays, and that the problem of disposal of nuclear waste will be resolved. But Wall Street isn't buying it. The nuclear industry can't get private capital to fund its rebirth. So to have any comeback, they need tens of billions of dollars in federal loans and federal loan guarantees backed by American taxpayers. The government appears to be ready to provide it. On June 30, 2008, the Department of Energy asked for application for $18.5 billion in loan guarantees for nuclear plant construction. The current administration is seeking to triple that amount to $54.5 billion. The Department of Energy announced its first nuclear loan guarantee on February 16, 2010, an $8.3 billion loan guarantee to the Southern Company for construction of 2 reactors in Georgia. Not to worry, the nuclear industry and the U.S. Department of Energy say the risks to taxpayer are low. However, the Congressional Budget Office estimated in 2003 that a nuclear power plant project would have a, quote, well above 50%, unquote, chance of defaulting on its loan guarantee. And that was for a plant that was estimated then to cost only $2.5 billion, with only 50% of that cost covered by a loan guarantee. Cost estimates increased substantially after the CBO report in 2003, and Standard & Poor's predicted in October 15, 2008 that the construction costs of nuclear power plants would soar even further. Moody's has referred to the construction of a new nuclear power plant as a bet the farm investment for most companies. The purpose of this hearing is to determine whether taxpayer-financed loan guarantees for nuclear power plants are necessary to jumpstart the nuclear renaissance, whether they are being priced correctly, and whether they're likely to create a multi-billion-dollar liability for the American taxpayer and a multi-billion-dollar bailout for the nuclear industry. As my Republican colleagues have pointed out in their February 3, 2010 policy brief, quote, while loan guarantees can help utilities with near-term financing, they also create taxpayer liabilities, dole out preferential treatment, and distort capital markets, unquote. We're here today from witnesses from all parts of the political spectrum, Democrats and Republicans, conservatives, moderates, liberals. Finally, a source for a March 5, 2010 article in the Los Angeles Times described the situation the subcommittee is examining in the following way. Say you're buying a car. The salesman has a long history of telling lies, covering up mistakes, and breaking promises. He's trying to sell you a car that doesn't exist yet. So he's not sure what it will look like. It's likely to cost at least 2, maybe 3 times what it says on a sticker. Almost certainly will take him much longer to deliver it than he says it will. So the question before us, why would anybody buy that car? Chair recognizes Mr. Jordan.
Thank you, Mr. Chairman. And thank you for holding this hearing. When I travel around our district and our state talking about the future of our country, the issue of energy always comes up. And I like to frame it like this. Americans instinctively know that the world is a better place when America leads. We can lead economically, militarily, only if we have access to reliable and affordable sources of energy. That is why I'm an advocate for a common-sense, all-the-above American energy solution. Everyone here agrees that Americans need cost-effective energy, especially in these tough economic times. Unfortunately, some of my friends on the other side of the aisle take a position on energy policy that is unrealistic at best and disingenuous at worst. On the one hand, they tell us we have to reduce carbon emissions or the sky will fall because of man-made global warming. On the other hand, they impose such draconian regulatory burdens on building new nuclear power plants, the only zero-carbon source we have, that no nuclear power plant has been approved in over 30 years. At the same time, they continue to pour billions of dollars we don't have into windmills and solar panels that alone cannot deliver the energy we need. We cannot power our lives and our economy relying solely on sources of power like windmills and solar panels. Even this Congress can't pass a law that makes the wind blow or the sun shine. Does this mean that wind and solar shouldn't be part of the energy mix in the country? Not at all. We need an affordable energy that is available around the clock. We need an all-of-the-above energy policy where consumers, businesses, and the free market, not bureaucrats and politicians in Washington, make energy choices. I am skeptical of all government subsidies because I don't think Washington has the wisdom or, frankly, the ability to pick the right solutions for our nation's energy needs. That's what the free market does so well. I do not want the arrogance and abuse of power we saw with the government takeover of health care turn into the blueprint for restructuring the energy sector of our economy. The real reason we are here today is because some people are ideologically opposed to nuclear power, and the only reason these loan guarantees exist is to offset the cost of burdensome regulation that has been imposed by those who seek to impose their agenda on America's energy future. The best thing we can do as legislators is to clear away the thicket of regulations and subsidies that frustrates the market's ability to find the right mix of affordable energy solution that our country needs. The solution, quite simply, is less hubris, less government, more humility from Washington politicians. Thank you, Mr. Chairman. I yield back our time.
I thank the gentleman. For those that just joined us, the topic of the hearing is the $54 billion loan guarantee program for a new wave of nuclear power plants. Chair recognizes Mr. Foster. Mr. Issa, do you want to check in the cloakroom to see if Mr. Issa? Okay, fine. Okay, if there's no more opening statements, I'm pleased to announce that the subcommittee will now receive testimony from the witnesses who are before us. I want to start by introducing our first panel. Mr. Peter Bradford is a former member of the U.S. Nuclear Regulatory Commission, former chairman of both the New York State Public Service Commission and the Maine Public Utilities Commission. He currently chairs Vermont's Public Oversight Panel on the reliability of Vermont Yankee Nuclear Power Plant. He was a member of the 2007 Keystone Center Collaborative on Nuclear Power and Climate Change and the 2006 National Academy of Sciences panel evaluating alternatives to continued operation of New York's Indian Point nuclear plants, and he's also advised several international bodies on nuclear issues. He's a graduate of Yale University and Yale Law School. Welcome, Mr. Bradford. Next is Dr. Arjun Makhijani. He is the president of the Institute for Energy and Environmental Research. He earned his Ph.D. in nuclear fusion at the University of California in Berkeley. He's author of numerous books and studies, including Carbon-Free and Nuclear-Free, A Roadmap for U.S. Energy Policy. That was in 2007. He is a fellow of the American Physical Society and has served as a consultant to the Tennessee Valley Authority, Lawrence Berkeley Laboratory, and several agencies of the United Nations. Welcome, Dr. Makhijani. Mr. Jack Spencer is a research fellow in nuclear energy at the Heritage Foundation's Rowe Institute for Economic Policy Studies, where he concentrates on subsidy policy, technology issues, and nuclear waste management. Previously, Mr. Spencer worked at the Babcock and Wilcox companies on commercial, civilian, and nuclear energy issues, and that would be military nuclear energy issues. Thank you for being here. Finally, for this panel, Ms. Leslie Cass. Ms. Cass is Senior Director of Business Policy and Programs of the Nuclear Energy Institute, where she's responsible for developing and managing programs related to the business and financial aspects of the nuclear industry. Ms. Cass has 17 years in the industry, having worked for utilities and a uranium enrichment company. She holds a bachelor's degree in materials science and engineering from MIT and an MBA from Duke University's Fuqua School of Business. I want to thank all the witnesses for appearing before the subcommittee. It's the policy of the Committee on Oversight and Government Reform to swear on all witnesses before they testify. I would ask that you please rise and raise your right hand. Do you solemnly swear to tell the truth, the whole truth, nothing but the truth? Thank you very much. Let the record reflect that each of the witnesses answered in the affirmative. I would ask each witness to give a brief summary of your testimony, and to please keep this summary under 5 minutes in duration. Your entire written statement will be included in the record. And I'm grateful for your presence here. Mr. Bradford, you'll be our first witness on the panel. You may proceed. Do you want to bring that mic a little bit closer? Go a little bit more. People can't hear you in the back.
Take the risks that investors and lenders are refusing to assume will reduce climate change. The opposite is true. Such an undertaking will undermine the fight against climate change by diverting money and attention from the resources that offer much larger atmospheric pollution reductions much sooner and less expensively. One must begin by understanding the reason that new nuclear plants have not been built in the U.S. for decades. It has nothing to do with the U.S. reactor licensing or regulatory processes, which licensed more plants than the next several countries combined. It has everything to do with cost and with risk. Competitive power procurement, as adopted in free market economies over the last 25 years, shifts the economic risk of all new power plant construction, risks such as plant cancellations, cost overruns, and emergence of cheaper competitors, from the customers to investors and lenders. Aware that each of these risks had hit the nuclear industry hard in the recent past, investors and lenders would not put their own money at risk by committing to competitive prices and delivery schedules for new reactors. Loan guarantees are the centerpiece of the present effort to reverse the successful 30-year evolution of competitive power markets by shifting the risks to taxpayers. But loan guarantees do not lower any actual cost in the way that cheaper steel or concrete would do. For example, the savings that the recently announced $8.3 billion loan guarantee appear to produce for Georgia's proposed Vogtle reactors are offset by a new taxpayer risk exposure of almost $100 taken on by every family in America. And every additional $10 billion in taxpayer-backed loan guarantees will add another $100 to this exposure. At its peak in 2008, the nuclear renaissance consisted of 23 existing and projected applications for 34 new reactors. Since 2008, reality has set in. Nuclear cost estimates have risen, demand has fallen, as have the cost estimates for most major alternatives. Several nuclear projects have been canceled outright. Most of the remaining 16 applications for 24 reactors have experienced combinations of major cost overruns and major delays. Most, indeed probably all of these reactors will not be built without loan guarantees. The economic and political impact of trying to charge the full cost to the customers is just too great. Customer backlash in Florida and in Texas has already demonstrated this. By way of response to the subcommittee questions directed to me, I'll summarize as follows. First, are the cost overruns in the construction of nuclear power plants a thing of the past or a present-day problem? Well, we have no current U.S. nuclear construction experience on which to base an answer. However, the trebling of U.S. nuclear cost estimates in less than a decade is not encouraging. Experience in Finland and in France with the design that Areva proposes for Maryland's Calvert Cliffs, a loan guarantee finalist, is also not encouraging. In Finland, the Areva reactor, originally scheduled to be online last summer, has doubled Areva's cost estimate and fallen at least 3 years behind a 4-year schedule. Some Asian nations claim more success in building to schedule and budgets. Energy Secretary Stephen Chu asserts that if the proposed loan guarantees result in plants that come online on time and on budget, private capital for new nuclear will then become available. But this is wrong. Today's on budget is so high in relation to the price of alternatives, to the prices projected in our power markets, and to the price of energy efficiency that even if new U.S. reactors come online on budget, the financial community will not invest. Second, do we currently have such a demand for electric power that we need to rush into construction of multiple nuclear plants? The U.S. has little or no demand for wholesale electric power, and new nuclear is forecasted 12 to 20 cent per kilowatt-hour price range. If we make wise use of far less expensive energy efficiency, renewables, and natural gas, we will not face electricity shortages even if we adopt policies that put a meaningful price on greenhouse gas reductions. Third, do increased loan guarantees for nuclear power plants misdirect resources? Yes. Those who argue that we have to subsidize many new reactors along with all of the alternatives ignore the economic reality of limited resources and the fact that new nuclear reactors cannot produce near-term greenhouse gas reductions. Furthermore, I can attest from my own experience regulating in Maine and New York that entities and states committed to building large nuclear projects will de-emphasize and even resist alternative sources. One need only look at New Hampshire's 1980s resistance to Hydro-Quebec power, or the opposition of Maine utilities to renewable cogeneration and energy efficiency, while the region's utilities struggled to finish Seabrook and Millstone 3 to see this effect clearly. The same was true in New York, while Shoreham and 9 Mile Point 2 preoccupied the state's utilities, and the same is true in Florida today. However, the problem of misdirected resources is much broader than this. Loan guarantees do not create new capital. They merely create a favored class of borrowers who will have easier access to the available capital than will all other would-be borrowers. Murray Wiedenbaum, who was later chairman of President Reagan's Council of Economic Advisors, critiquing the failed program to manufacture synthetic fuel from coal many years ago, noted, "A basic function that credit markets are supposed to perform is that of distinguishing credit risks and assigning appropriate risk premiums. This function is the essence of resource allocation by credit markets. As an increasing proportion of issues coming to credit markets bears the guarantee of the federal government, the ability of the market to differentiate credit risks inevitably diminishes." Fourth, will the proposed Clean Energy Deployment Administration adequately deal with the risk of defaults? The answer is not as presently written. The Senate version of CETA, because it has the potential to underwrite unlimited nuclear loan guarantees, is particularly problematic. Secretary Chu recently estimated that the price to be charged for a loan guarantee would range between 0.5% and 1.5% of the face value of the guarantee. For the conditional loan guarantee recently approved for the Vodal units, this would mean that the average family would receive between 50 cents and $1.50 for its $100 exposure. Other estimates of reasonable credit subsidy fee are considerably higher. For example, the Congressional Budget Office estimated 30% in 2003. Standard & Poor's estimated 4 to 6%. The Center for American Progress recently did an analysis concluding that the payment should be 10%. Underpricing of risk is, of course, a root cause of the current financial crisis. To make matters worse, the Department of Energy apparently intends to keep secret the credit subsidy fee charged to each guarantee recipient. The people disadvantaged by this secrecy will be first the public, who will not be able to quantify the extent to which DOE has exposed American families to uncompensated risk. Second, builders of other forms of power generation and energy efficiency, who will not be able to prove what now seems very likely, that DOE intends to charge less for guarantees to highly risky nuclear ventures than it will charge for loan guarantees to more secure renewable and solar ventures. Third, state utility regulators, who may be unable to set rates based on actual costs, since loan recipients may allege that they cannot disclose these costs in a public forum. In conclusion, whatever the appeal of offering a limited number of loan guarantees to a few first-mover plants, meaning 6 or 7, as part of a bargain that succeeds in passing a meaningful cap-and-trade program, the discussion of loan guarantees in Congress seems to have spun far outside of that orbit. A larger commitment would proclaim new reactors to be a climate change winner when all meaningful economic evidence is to the contrary. It would put energy and climate policy at the service of nuclear power. Sound public policy works the other way around. Thank you very much.
Thank you, Mr. Chairman. I really appreciate the opportunity to testify before you, and I just want to take this personal opportunity to thank you for reading my book, Carbon-Free, Nuclear-Free, and for making part of your presidential campaign. Thank you very much. You asked me 6 questions, and I'll just go question by question and summarize my testimony along those lines. The first question was, why won't Wall Street invest in nuclear power plants, and why does Moody's call them bet the farm investments? Now, I'll just give you some examples, starting with a quote from the CEO of General Electric, Mr. Immelt. He was quoted in the Financial Times as saying, "If you were a utility CEO and looked at your world today, you would just do gas and wind. You would say they are easier to site, digestible today. I don't have to bet my company on any of this stuff. You would never do nuclear. The economics are overwhelming." Now, he was promoting loan guarantees because you couldn't do nuclear without betting the company. What does betting the company mean? Let's take some examples. Progress Energy wants to build 2 reactors in Florida, whose estimated cost is $17 billion. Now, these are company estimates. Progress Energy's market capitalization, when I wrote this testimony last month, was $10.85 billion. That is, the cost of the project is a lot more than the market cap of the company. Florida Power, a little bit better. Its price tag is $14 billion for 2 reactors, and its market capitalization last month was $19.4 $1 billion. But still quite close to the market capitalization of the company. If you look at CPS Energy, which is one of the country's largest publicly owned utilities, a municipal utility of the city of San Antonio, its entire assets, gas, electric, buildings, transmission, distribution, the net value of those assets at the end of its last fiscal year in January 2009 was $6.4 billion. And it had at one time 50% of a two-reactor project in South Texas. And that 50%, one reactor, is now estimated to cost $9.1 billion, quite a bit more than the net worth of the whole company on the books, on its own books. Now, Wall Street has flatly refused to finance these projects. There are three problems. It's not just the high cost. It's the long lead time compared to alternatives, which also compounds the risk. And it is the large unit size, which also compounds the risk. And I just would like to add that Mr. Bradford mentioned that nuclear would squeeze out alternatives. And one reason it squeezes out alternatives is that when you put more than the value of your company on one project, and that project isn't going to return $1 to you for 8 or 10 years, you can't afford to put another comparable investment in anything else. Now, in Florida, ratepayers are paying in advance for these reactors without any assurance that they're going to get any electricity in return. The legislature there passed a construction work in progress law, and it's not just homeowning ratepayers that are protesting. Businesses are also protesting. Here's what the Washington Post said. Utilities' advance payments are consumers' losses, and businesses such as Georgia Industrial Group and Georgia Textile Manufacturing have joined consumer and environmental groups in combating state laws and higher rates. Now, the 4 reactors in Florida are in some question as a result of this ratepayer protest, including ratepayers, business ratepayers who are not against nuclear power. They just say we don't want to pay in advance, and they have no guarantee they're going to get anything for this money. It's like giving a builder an advance to build you a house, but you have no contract that says they're actually going to build it and give you the keys. If they abandon the project halfway, you have no recourse. Now, the San Antonio case is actually very interesting because the city's utility spent about $370 million on paperwork and initial engineering. They don't have a final price. They won't have a final price till 2012. And its partners, NRG Energy and Toshiba, were 50-50 initially in this project. There was an alleged cover-up of the cost overruns. Initially, the company had said $5.4 billion, then $6 billion, and $7 billion. When I arrived on the scene in San Antonio in March 2008, when I assessed the project, I felt the cost would be between 12 and 17 billion in round numbers, as you have said, Mr. Chairman, 2 to 3 times what the company said at the time. By last fall, it seemed clear that their cost estimate was going to be something like $18 billion, a little bit more than my high end. Now the project is in something of a mess because CPS Energy wants to withdraw. You asked me about new reactor designs.
Just ask the gentleman if you could wrap up your testimony, and then maybe we can get to some of the other points in the question period.
Sure.
Thank you.
Should I wrap it up now? Or do you want me to go over some of the other points?
If you would make the last point you wanted to make, and then we'll have to move on.
Okay. The last couple of points are that there is no reactor that we have that is proposed to be built that is fully certified as of now, because the certified reactors have design modifications they've asked for. And I would say that 3 or 4 years ago, I believed that it would be impossible, essentially. It was an educated guess to make a renewable energy system in this country. And I changed my mind when I did the research. That's why I wrote my book, Carbon Free, Nuclear Free. I believe it's possible to do an economical energy system, and I've debated nuclear energy and nuclear power proponents on this numerous times since my book was published.
Thank you, Dr. Makajani. And members of our committee will have an opportunity to get to questions and some of the other points you wanted to make. I'm sure you'll be able to get in. Chair recognizes Mr. Spencer. Thank you for being here. You may proceed.
Chairman Kucinich, Ranking Member Jordan.
And would you pull that mic a little bit closer so we can all hear you? Thanks.
My name is Jack Spencer, and I'm Research Fellow for Nuclear Energy Policy at the Heritage Foundation. The views I express in this testimony are my own and should not be construed as representing any official position of the Heritage Foundation. A limited loan guarantee program can help overcome some near-term financing obstacles, but President Obama's expansion could transform a limited program into a broader one that threatens to institutionalize both the existing systemic challenges as well as inefficiencies that subsidies ultimately create. By subsidizing a portion of the actual cost of a project, nuclear or otherwise, through a loan guarantee, the government is actually distorting the allocation of resources by directing capital away from more competitive projects. These subsidies have 4 market-distorting properties that I would like to discuss. First, the loan guarantee artificially discounts the cost to build a project, which allows the recipient's project to be market viable at a point where it otherwise would not be. This allows the recipient to focus on other measures, even securing the next subsidy, rather than addressing cost-inflating issues. Second, this artificial price reduction removes the incentive to look for less expensive or more competitive options. It also hurts competition within the nuclear industry. A utility that cannot afford a large, subsidized reactor might be able to afford multiple smaller ones. This would create competition, and the subsidized technologies would either have to reduce costs or lose market share. Third, a major problem facing nuclear power in the United States is not that it lacks subsidies, but that the regulatory environment does not promote growth, innovation, or competition. Regulatory reforms could substantially reduce the investor risk, which would be reflected in lower financing costs. Guaranteeing the loans reduces near-term pressure to fix this ongoing problem. And finally, they suppress private sector financing solutions. Companies routinely invest in projects with substantial risk without government loan guarantees. Finding a way to develop an investment is at the heart of free enterprise, but loan guarantees distort this process and remove the incentive to come up with better long-term solutions. If loan guarantees are expanded, they must be coupled with reforms and conditions. Any expansion of the loan guarantee program should be accompanied by the following 5 conditions, which would help reduce their market-distorting effects, protect the taxpayer, and ensure a strong, market-viable nuclear industry in the long term. First, end loan guarantees and capital subsidy programs. Stopping the program at $54.5 billion in total loan guarantees, which is the President's total, would at least limit the damage and provide a deadline whereby industry and government must have resolved their outlying issues. Second, ensure that the recipients pay the full cost of the subsidy. While the President's budget did not request funds to pay for the subsidy cost, legislation introduced over the past year has. This should be avoided. An accurate financial assessment should provide a market incentive to reform the policies that give rise to the risk to begin with. This will occur, however, only if the true cost of the subsidy is assessed and if guarantee recipients are responsible for paying that cost. Third, make recipients privately refinance within 5 years of project completion. Rather than a long-term financing option, the loan guarantee program should be viewed as a bridge program to protect investors against project failure during its most vulnerable stages. Upon completion, loan recipients should privatize liability by refinancing without support of additional taxpayer backing. Fourth, limit loan guarantees to no more than 2 plants of any reactor design. Completing the permitting process for 2 plants that share a single reactor design should be sufficient to establish regulatory integrity. This condition would also ensure that no one reactor design monopolizes the program and that federal regulators diversify their regulatory experience. And finally, limit to 2/3 of the loan guarantee program that can support a single technology. Because regulatory support is a necessary prerequisite to reactor use, and the regulatory environment favors large light water reactors, nuclear investors tend towards this technology as it poses the least regulatory risk. Ensuring that the subsidy is not consumed by a single reactor type should help break the regulatory monopoly currently held by light water reactors by lowering the relative risk of emerging commercial nuclear technologies. If not subsidies, then what? Whether through the promise of subsidies, regulatory problems, unworkable waste management policies, or DOE programs that stifle competition, the current policies are not working. The following reforms should be pursued instead of subsidies. Reform the permitting process for new nuclear power plants. Creating a more efficient and predictable permitting schedule should be a top priority, but that alone is not enough. The NRC must also be better prepared to regulate reactor technologies beyond large light water reactors. Waste management policy reform. The current system is driven by government programs and politics. There's little connection between used fuel management programs, economics, and the needs of industry. Any successful plan must grow out of the private sector and be driven by sound economics. And finally, supporting the NRC's authority to determine the safety of Yucca Mountain. The NRC should be allowed to review the Department of Energy's permit application for the Yucca Mountain constructed and operated safely. In conclusion, a true nuclear renaissance cannot be micromanaged from Washington, but with the right free market policies in place, nuclear energy has a chance to literally change the world. That concludes my testimony. I look forward to your questions.
Thank you, Mr. Spencer. Ms. Cass, you may proceed.
Thank you, Mr. Chairman. Chairman Kucinich, Ranking Member Jordan, and members of the subcommittee, thank you for your interest in loan guarantees for the construction of new nuclear power plants to meet our nation's energy needs and reduce carbon emissions. I appreciate the opportunity to speak with you today. As the President stated last month at the announcement of the conditional commitment for loan guarantees offered to the Vogtle nuclear project, to meet our growing energy needs and prevent the worst consequences of climate change, we'll need to increase our supply of nuclear power. It's that simple. Investing in nuclear energy remains a necessary step. I hope that this announcement underscores both our seriousness in meeting the energy challenge and our willingness to look at this challenge not as a partisan issue, but as a matter far more important than politics, because the choices we make will affect not just the next generation, but generations to come. To make the necessary transformation to a low-carbon economy while we upgrade aging energy infrastructure, consensus estimates show that the electric sector must invest between $1.5 and $2 trillion by 2030. This will fund new power plants, transmission and distribution systems, energy efficiency measures, and environmental controls. To meet the national policy objective of reducing carbon emissions, the public and private sectors must work together to ensure clean energy is affordable for consumers and businesses alike. By reducing the cost of capital, the DOE Loan Guarantee Program, authorized by the 2005 Energy Policy Act, serves the public interest by accelerating deployment of clean generating technologies at a lower cost to consumers. The federal government already manages a successful loan guarantee portfolio of approximately $1.2 trillion, which on balance returns more to the Treasury than it costs the taxpayer. The federal government uses these credit support programs to support shipbuilding, steelmaking, rural electrification, affordable housing, and many other purposes. To ensure the protection of the taxpayer interest, all projects seeking DOE loan guarantees will be subject to detailed due diligence and underwriting by a rating agency and by the DOE. This due diligence evaluates the technical, legal, and financial attributes of each project. The companies building new nuclear power plants will have significant shareholder equity, $1 billion or more per project, at risk. This equity is in a first loss position, meaning that the company would forfeit that equity in the event of a default. As a result, the companies seeking loan guarantees for new nuclear power plants have a powerful incentive to ensure that the projects achieve commercial success. The amount of misinformation about nuclear plant construction and loan guarantees is remarkable. One of the more egregious examples is the continued use of a 50% default rate from a 2003 CBO analysis of a different loan guarantee program that was never enacted. CBO Director Douglas Elmendorf was moved to explain on March 4th that the 2003 report, quote, reflected information about the technical, economic, and regulatory environment as it existed in 2003, almost 7 years ago. Such generalized estimates of credit risk may not apply to a guarantee for any particular power plant because of variations in the technical, economic, regulatory, and contractual characteristics of each project. Without such information, much of which would be proprietary, CBO has no basis for estimating the cost to the government of any specific loan guarantee of this type, end quote. Detailed analysis and historical data demonstrate that the new nuclear power projects being proposed for DOE loan guarantees provide a very high degree of lender protection. A realistic analysis of default probability and recovery rate based on project specifics will produce credit subsidy costs sufficient to protect the taxpayer's interest. Credit subsidy calculations must be approved by DOE's Credit Review Board, the Office of Management and Budget, and by the Treasury Department. Given the very low probability of losses associated with nuclear projects, the benefits far outweigh the risks. Electricity consumers will benefit from low-cost clean energy. Southern Company projects that its $3.4 billion portion of the loan guarantees for the 2 reactors at the Vogtle station would save consumers $15 to $20 million in interest costs annually. The program will create jobs for American workers. Each plant will generate 1,400 to 1,800 jobs during construction, with 2,400 at peak, 400 to 700 permanent jobs for plant operations, and 400 to 700 additional jobs in the community to support the plant workforce. Construction of new nuclear plants will create demand for commodities like concrete and steel and hundreds of components, large and small, that benefit American manufacturers. In addition to the existing U.S. manufacturing supply base, the industry is reaching out through manufacturing workshops to help businesses identify the opportunities in new plant construction. For example, over 300 companies from Ohio participated in workshops just last year. In conclusion, the Nuclear Loan Guarantee Program is an opportunity to build the clean energy facilities necessary to support our economy and to put Americans back to work. The analytics show that the risks of default are small, and as the President explained, the benefits cannot be ignored. Mr. Chairman, thank you again for the opportunity, and I look forward to your questions.
Thank you very much for being here, and I'd like to start with a question to you, Ms. Cass. Department of Energy representatives have been quoted as saying that the credit subsidy fee that Southern Company will pay for its $8.3 billion federal loan guarantee is proprietary to Southern Company and, quote, will remain confidential, unquote. Is that the industry's position, that the amount of credit subsidy fees for nuclear plant loan guarantees should be kept secret and should not be disclosed to the public or to the company's shareholders and bondholders?
I believe that the process by which we derive the credit subsidy cost should be very transparent for all stakeholders and for all projects, both those that are renewable, for which the government is covering the credit subsidy cost, and those for nuclear and other technologies where the borrower pays. Now, the very project specifics, I do believe, get into confidential information for contracts, so some of those pieces of information would need to remain proprietary, and where you draw the line, obviously, that's up to DOE and OMB.
Mr. Bradford, would you like to comment on that question? And could you pull the mic closer? The question relates to, should the credit subsidy fees remain confidential? Is it proprietary? Do the people, yes, taxpayers, have no right to know what's kind of skin they have in this game, or, you know, what do you think?
I think the proposition is beyond sober analysis.
What do you mean? I mean, you know,
there is no conceivable justification for withholding the credit subsidy fee being charged to these projects.
Well, but wait, you're not answering the question. I mean, they're saying it's proprietary. You know something about the nuclear industry, so is there any justification in terms of the business sense that it's proprietary information?
Not the credit subsidy fee itself. It can't possibly be proprietary. It's the amount that the taxpayers are receiving in return for extending the loan guarantee. And they're being told, taxpayers, that they can't know what level of protection they're receiving. The justification that DOE advanced, that is that other applicants for loan guarantees might complain if they felt that they had gotten unfairly treated, is in fact the exact reason why they should be aware of what type of treatment has been extended to their competitors. If the solar industry is being charged 10% and the nuclear industry is being charged 1%, damn right they should know it and be able to complain about it.
Dr. Marcagiani, you know, what's your opinion of a credit subsidy fee that's secret and not disclosed to the taxpayers?
Well, Mr. Chairman, first of all, the subsidy fee will give us some idea of how the government values the risk of default and whether it's realistic or not. In my opinion, the risk of default is quite high because nuclear power plants take so long to build. They may be economically obsolete before this first set goes online.
So why would this subsidy fee need to be made public then?
Well, we need to know whether the subsidy fee is adequately covering the risk and what the risk analysis is that leads to a specific sum of money.
Mr. Spencer, what's your position on this credit subsidy fee? Do you think, from a business standpoint, it ought to be proprietary and should remain confidential?
Well, I'm not in the business sector, so it's not really fair for me to answer
Oh,
from
well,
that
from an
perspective.
economic
But
standpoint.
from a public policy standpoint, I think that we do need transparency over the subsidy cost, and I think that it's critical because really that has a lot to do with as we just heard, what the risk is associated with this. And I think it works on both sides. I tend to believe that the risk associated with nuclear power would be relatively low. So I think that it should be made public, but it is absolutely critical that that those important business aspects remain confidential. So we need to figure out a way to do that.
Okay, thank you. Ms. Cass, on the back cover of the current National Journal, the staff could put the copy up, there's an ad with the headline, Southern Company is investing $6 billion in clean, reliable, affordable energy. My question to you is this: wouldn't it be more accurate if Southern Company had stated that it was investing $6 billion of taxpayers' money, that this $6 billion is going to be coming from taxpayers' money from the federal financing bank? Isn't that right?
Actually, sir, I had in my testimony, Southern Company's portion of the loan guarantee is $3.4 billion. So they are getting a guarantee for a $3.4 billion loan. And the rest of their portion of the project, they're about a 46% owner, would come from owner's equity. So there's quite a bit of their own cash invested as well.
Is that loan taxpayers' money that they're referring to?
The $3.4 billion?
Is there any taxpayers' money in there at all?
It comes from the federal financing bank because that is the way the loan guarantee program rule is written. They're required to access that from the federal financing bank.
And that's taxpayers' money, right?
It's the federal financing bank, so yes.
Chair recognizes Mr. Jordan.
Thank you. Mr. Chairman, let me, housekeeping first, if I could ask unanimous consent to get Ranking Member Ice's statement entered into the record.
So ordered.
Thank you. Let me go to Mr. Spencer and Ms. Cass, if I could. Mr. Bradford, in his testimony, stated, and I'm reading from it, the reason no new nuclear plants have been built in the U.S. for decades has nothing to do with the U.S. licensing process and has nothing to do with citizen interveners in the court hearings. And yet, I think Mr. Spencer's testimony, he talked about a 4-year time frame to get a permit for a new reactor. When I look at the memo that the staff put together, it's 3 to 5 years, both licensing and permitting. I mean, do you agree with Mr. Bradford's statement that it's not has nothing to do with the cost of these building these has nothing to do with the requirements that the government has in place? Mr. Spencer and then Ms. Cass.
No, I think clearly the permitting process has more than nothing to do with it, though that's not the only problem. And we've seen this historically, really starting in the early 70s, the regulatory burden growing on nuclear energy throughout that time period, certainly into the 80s. As the regulatory burden grew, there were other systemic problems, energy prices changing, the downturn of the economy, all contributing to the reduction of the use of nuclear energy.
So is this, for Joe Layman here, is this, it's almost like the government chasing its tail because we got this high regulatory burden which adds cost to the project. Well, then we need to put taxpayer money at risk so that someone will actually undertake the project, and then because that, then we add more burdens because taxpayer money is at risk, and it's a bad spiral for energy needs for the country and taxpayer dollars that are being put at risk in the first place.
I agree with the way that you just described that, but let me be clear, it's not just a regulatory burden. There are policy issues with nuclear waste and some other things that add the unpredictability into the system that increase the risk that then leads to the need for taxpayer support.
Okay, but you would argue that the regulatory burden is a factor. Would you say a big factor,
I would
huge
say
factor?
a significant factor.
Significant
yes.
factor. Would you agree, Ms. Kath?
Yes, the time to market for nuclear in this country right now is about 10 years, and a lot of that is licensing. There are currently 54 reactors under construction worldwide, with several more planned, and other countries are moving forward who don't have a similar regime.
Okay, now, so with that being established, what specifically needs to change on the regulatory side? I mean, I think Mr. Spencer in his testimony, he talked about almost a bias the government has for certain types because the regulators get accustomed to approving that type of reactor, and I don't know enough to make the distinction. But so what needs to change on the regulatory side that would help the process?
The thing we need most right now is experience. We have a new Part 52 licensing process that allows for designs to be certified up front. You can also have a site certified environmentally up front, and then you could put in your combined license. We believe in the second wave we'll be down to about 2 years for a combined license, provided that we are efficient with the process. The industry has some recommendations for making sure that we take out some of the redundant reviews between the early site permit and the COL, as well as ensuring that the hearing process, again, involves all the public stakeholders, which this new process involves everyone up front, which we feel is very positive and is very transparent, but involves them, but in a way that doesn't lag on.
Okay, let me ask this, and this I simply just don't know. How long does the process take for a coal-fired, coal-powered plant? How long does the process take to approve any type of wind project or solar panel project? Is it comparable, or is it much shorter, much longer? Give me the comparisons.
I don't know the answer to that question, but I can find it for you. But I do know this, that each of those projects that you just brought up are currently facing the regulatory delays for a lot of the same environmental reasons that are facing nuclear, interestingly enough.
Interesting.
Really across the board, we are facing a situation where our infrastructure construction is being hamstrung because of unreasonable regulation. This problem of regulation is not just one for the nuclear industry, though that's what we're talking about today.
Yeah.
It's something that we need to face generally in this country.
I'd agree with that. Okay. Thank you, Mr. Chairman.
Chair recognizes Mr. Foster.
Thank you. Let's see. I'd start with Mr. Makijani. I was wondering if you have an opinion on the suggested design point of multiple small nuclear, things that are basically plucked off an assembly line, thereby reducing the time between when you manufacture the modules and the time that you actually get a revenue stream. If you really are optimistic that that will have a transformative effect on the economics of nuclear projects, particularly when they're sited on an existing pre-approved site where there's already a reactor approval?
I'm actually not very optimistic, and the reasons are as follows. I mean, there's obviously some advantage to saying we're going to manufacture small nuclear power plants on an assembly line basis rather than putting together a special project each time on site. However, there's a reason we have large reactors. It's because of economies of scale, and the economies of scale work as follows. The cost of the materials and the construction goes approximately as the surface area of the reactor vessel or the containment building, and the amount of power you generate goes as the volume of the reactor vessel. Now, the volume increases much faster than the surface area when you increase the size of the reactor. That's why we have 1,000-megawatt reactors rather than 100-megawatt reactors. If you imagine a ball, the volume of the ball increases much faster than the radius or the surface area of the ball,
right, but
something like that.
Yes, but for a larger, I mean, if you're going to argue physics or engineering here, but the hoop stress, there's a famous result when you're designing a pressure vessel that the total mass of the pressure vessel is sort of independent of whether it's a small or large radius pressure vessel. And so there's sort of second order effects here. Anyway, you have to do the whole engineering study of the big and small ones to get the answer there. I think it's a little more complicated than elementary.
If I might add, yeah, it is quite complicated. I was just giving you one reason why the cost might not come down as much as is being advertised. And secondly, with nuclear reactors, you have radioactive materials inside a high-pressure vessel, and that's part of the reason why the cost of reactors are high as compared to the cost of an ordinary boiler is because it involves very particular risks, and you have to investigate and check every weld and so on, and you're going to have to do that in the factory as you have to do it at the site.
Right. And so I guess I had a question. I'm not sure who should cover this, but I don't understand exactly how the secret interest rate subsidies work. I mean, aren't these regulated utilities where your books are pretty much open to the universe? How do you succeed in keeping these secret? Is there anyone that can help me with this?
Well, I can try. The Department of Energy has announced that they will treat the fee to be charged for the loan guarantee as proprietary to the recipient of the loan guarantee. So they, who are the ones who decide the fee, have no intention of making it public. in the states in which generation is still regulated, the Commission, of course, can ask for it, but they're likely to be told that it's proprietary information and that the Department of Energy has so certified. That means they may be able to see it themselves, or they may not, but in all likelihood, they won't be making it public either. So it will remain secret in those state proceedings as well, if DOE persists in this misguided course, which I hope they won't.
One way I view this and hold this debate here is, you're all familiar with the McKinsey report that basically says, look at all the ways we know how to mitigate carbon sphere and what is the net present value of all these different systems. And I was wondering, one of the things I struggle with is the fact that there isn't a trusted third party to actually report the real world cost of this. What we have are proponents' cost estimates on different things with wildly different, views of the real cost of capital, project costs associated with project risk. Is there any trusted third entity, or who would you in the panel prefer as to be established as the trusted third party to actually come up with a fair apples-to-apples comparison of the cost of producing electricity by all these? Yeah, Mr. Spencer?
Might not be the answer you're looking for, but there is a trusted third party that assesses real-world costs, and it's the marketplace. That's the problem with Washington deciding which of these things to do. You're taking, instead of the millions.
Yeah, but that completely ignores all of the externalities and indirectly imposed costs on there.
Well,
the market
I would argue the
alone
marketplace
will
actually
not
takes
get
all of those into consideration in a much better way than Washington. If Washington were the best place to do it, we should just have a command and control economy.
No, it's simply the free market. Well, it has no way of dealing with the external costs imposed by various solutions. Yeah.
So I
yield back. I'm afraid my
May I
time.
answer that?
Gentleman's time's expired. What I'd like to do is, Mr. Towns, have a question in this round? Okay. Well, we'll pick up on that point which Mr. Foster raised, and I was intrigued with Mr. Spencer's answer, and actually. You may find surprise occasionally in this committee about who may concur with your answer, because if, as someone who voted against the bailouts, why is this industry having trouble getting financing from Wall Street? I mean, if the market is the arbiter, as you say, they're asking for tens of billions of loans and guarantees from the federal government. Why can't they get that money from Wall Street? Help me out with that.
Well, I agree that subsidies are not the way to go. My belief, because I believe in the potential of nuclear energy, is that we need to address the underlying problems, which I believe are an antiquated regulatory process. I believe we don't have a waste management system that brings any sort of predictability to the process. I believe that there's overdependence on government. These are the underlying issues that create the whole basket of unpredictability that leads to the need for subsidies. And it's not just nuclear. I think that wind and solar, these other things, fall victim to the same thing, sir. That's the whole problem with Washington dictating this process. We need to throw it out there, throw it to the marketplace. Maybe someone comes up with a new wind technology that is great and affordable. Then it'll beat nuclear.
Let me ask Ms. Cass. The nuclear industry is asking for tens of billions of dollars in loans and loan guarantees from the federal government. Can't get financing from Wall Street. Why should the taxpayers take on risks that the private investment community is afraid of?
We have a structural imbalance in this country because of the size of our utilities. It's one of the few things Dr. Makajani and I will agree upon, is that the size of our utilities is relatively small compared to that capital spending I mentioned of $1.5 to $2 trillion that has to happen between now and 2030 to upgrade and clean up our electricity infrastructure. So given that, it's very difficult for the companies to raise enough capital. Now, Wall Street has supported small tranches of capital for the projects, like the MEAG went for a bond offering that was specifically highlighted for the nuclear project. We've had some other other smaller capital offerings. But when you come to a guarantee of this size, and again, this is our first time coming back to construction in many years with a new regulatory regime, there is some nervousness, but long term there's a structural problem. EDF in France and TEPCO in Japan, they're very large and they can fund these on balance sheet because they're hundreds of billions of dollars on their balance sheet. We don't have that here in the U.S. The largest electric utility is in the roughly the 30 to 35 billion range.
Well, we've heard some earlier discussions here about the issue of risk, and if Southern Company defaults on its $8.3 billion loan, what would happen to the taxpayers? What would be the result to the taxpayers?
It all gets down to recovery, what you assume the recovery rate is and the probability of default. Southern Company has put their balance sheet behind this transaction, and they also have significant equity, again, in a first loss position. They have other partners that diversify the risk.
Here's the thing that concerns me. Mm-hmm. What concerns me is that I'm asking, you're there representing the industry. I've got that. I'm very clear on that. I'm wondering what sympathy you have for the U.S. taxpayers. And I don't hear that.
I am a U.S. taxpayer, sir, and
but you're not going to fork up billions of dollars yourself. I'm just looking for some kind of sentiment on your part of your concern for what the U.S. taxpayers here have at stake. That's what I'm just trying to figure out where you're coming from on this.
Well, I think when you look at the analytics, and as I mentioned, the risk versus the possibilities of what we have to do here, I as a taxpayer am concerned that we're going to come up with energy costs so high that it crushes our economy as we try to go to a clean energy economy.
Ms. Cass,
and that's my concern.
I want to go to Mr. Bradford. What happens if there's a default? What's the impact here?
Well, if there's a default, at that point, presumably the project is going to either change hands or stop, and the components will be sold off. There'll be a net loss, and that net loss will be charged to the taxpayers. But I wonder if I could comment on this issue of the size of the utilities, because it doesn't seem to me to be remotely the problem that the industry asserts it is in justifying loan guarantees. All that's needed is to match a consortium to build the plant with the size of the project being undertaken. If the buyers are there and the plant can produce an output at a reasonable price, it's financeable. We finance bigger projects than nuclear plants in the country, but the difficulty lies in mismatches between what's being undertaken and the size of the individual companies. The Florida companies are trying to find buyers for their shares of the plant. Other utilities aren't interested in buying in because it's too expensive. And the way we've built nuclear plants in the past is by putting consortia of companies together. There are consortia backing each reactor design that have assets and gross sales bigger than 100 countries combined. It's about risk and it's about cost. And that's true also, incidentally, with regard to this issue of the regulatory process. I mean, for God's sakes, Ralph Nader has not been appointing the nuclear regulatory commissioners for the last 30 years. The regulatory process about which Ms. Cass is concerned has been made up of presidential appointees, not one of whom her organization opposed until Commissioner Jaxco a few years back. So what are we to believe? That this group of presidential appointees has come up with a regulatory process that is hostile to the industry? No, this is a regulatory process of the industry's design and choosing for 3 decades.
Thank you, Mr. Bradford. Chair recognizes Mr. Jordan.
Thank you, Mr. Chairman. Mr. Bradford mentioned it's about risk. It seems to me, and Mr. Spencer raised this a couple times already, that the risk of what you do with the waste has to be something that's factored in. And the current administration's decision concerning Yucca Mountain, that has to contribute to the cost and the uneasiness of investors to take that risk. Ms. Cass, would you agree with that?
As far as the waste is concerned, it certainly has not helped the risk perceived from Wall Street. What I will say is the waste is currently safely stored on our sites. The industry supports the Blue Ribbon Commission and looks forward to being able to move forward and have a national plan.
Some certainty on that question would help with potential investors taking a stronger look at investing in one of your facilities.
Yes, having certainty on the waste question will be very helpful to us.
Yeah, I would argue that when you think about our entire economy, having some certainty about what's going to happen with our energy policy, I think the uncertainty of are we going to have a cap and trade, the uncertainty are we going to have other policies that's being talked about in Congress, I would argue that's a big factor in why our economy is not growing and responding the way we would like as we come out of this recession. Mr. Bradford, you and Dr. Are not in favor of the loan guarantee program for nuclear plants. Are you in favor of loan guarantees or subsidies for other forms of energy, ethanol, wind, solar? Do you support those programs that taxpayer money is currently being put at risk with right now? Mr. Bradford.
I think the process by which we choose and allocate federal support for energy technologies is deeply flawed, and I'll join with Mr. Spencer in wishing that we paid a good deal more attention to market verdicts, tempered, however, by attention to externalities, and there are various ways one can incorporate them.
Appreciate that.
That said, I'm much more comfortable with support at the research and development level for technologies that seem to promise carbon reductions and other benefits quickly than I am with support for commercialization of large
Which is it?
scale projects.
I mean, go back to my question, yes or no? You support help for alternative energy?
In the R&D sector, based on the potential to alleviate the various problems in terms of energy security and environmental protection, yes, I'd be supportive of a substantial program in that area. When it comes to it comes to commercialization, that is actually taking projects and building them for the large private entities who would normally build it for themselves, I have reservations across the board about the way we do that.
You'd be against it on the commercial, when you get to the commercial portion, you'd be against that? For ethanol, for solar, for anything?
I'd rather.
I'm just trying to know. I'm just trying to figure out.
If you want to take the time to go criterion by criterion, project by project, I'd be glad to do it. I kind of think you don't.
Support government picking winners or losers.
I would be much happier with the government playing a much lighter role in the commercialization of all alternative energy technologies. I wouldn't say no role at all.
Yeah.
Well, actually, Congressman, in my testimony on page 11, I say that, in my opinion, government loan guarantees are not a suitable way to encourage development of any energy source. And I say especially ones that are very risky due to
What about other forms of government support?
No, I actually, I'm not a proponent of subsidies. I think we've got a very complicated thing where some very old industries like nuclear and coal and so on have some subsidies, and you've got wind and solar that now have investment tax credits, production tax credits. I actually think that these production tax credits should be phased out in 8 or 10 years with this sunset, whatever the legislation is. And the best way to support a new energy marketplace by government is for the government, federal, state, and local, to put its own house in order. I have been a proponent in my book and in other forums. What I'm saying here is that if the government made its buildings and infrastructure, cars, vehicles more efficient, if the government at state and federal levels simply put out a purchase order for the kind of energy sources that it wanted each year, I think even much of the R&D would take care of itself, because people would compete to develop new energy sources to supply the government with low CO2 energy sources or energy sources with other similar attributes. So I think the government should put its own clean energy house in order. And I am not a big proponent. I'm actually fairly much a fiscal conservative in that I am not a proponent of big government subsidies for anything.
Okay. Thank you, Mr. Chairman.
And certainly not prolonged subsidies. I think nuclear has had R&D and subsidies for 50 years and continues to enjoy subsidies. And I think more than enough.
I would put a price on carbon. That's the only addition I'd make to what I said before.
Chair recognizes Mr. Foster.
Yeah, I think, well, the carbon is one example of an externality that we have to figure out how we'll deal with. Another one is obviously, the waste problem in nuclear. You can't say that, oh, it's just the free market, and if I want, I can set up a waste repository in my backyard without consulting my neighbors, whether that's okay or not. And so we have to come up with deal with the reality that it's a mixture of a regulated and a free market environment that we're always going to be in, and that makes it hard not to game. But I actually see a possibility that you actually agree in principle here at something that's very much like what the approach taken in the McKinsey report and other ways, where you just do a hard-eyed economic analysis of what is the cost of producing energy, the levelized cost, the total project cost, factor it all in, but do the calculation right. Okay, and with the exception of externalities, which we're going to have to argue about and get settled, that is the way that actually this should be handled. And that those who advocate nuclear, I think that when you do that analysis right, you're going to show that the McKinsey report showed it was pretty much net present value neutral, as I recall, investments in nuclear. They viewed as many of the renewable things had a very positive cost to the GDP, and they reviewed things like efficiency improvements as massively negative in terms of saving the economy money. And I think that, do any of you really have an objection to that as the basic approach for setting policy here? And what we really need to do is get these numbers right and set up some entity that we all trust to go through the real cost of these things. I guess I'll start to the right here. And yeah, Ms. Cass.
Thank you. And our utilities look at the levelized cost of electricity, and that's how they make their investment decisions for their precious capital as well. And the third party I would recommend is the National Academy of Sciences. The National Research Council, for instance, put out a report in 2009, actually. In 2009, they have a draft report out that looks at the levelized cost across all technologies and shows that, for instance, nuclear is in the competitive range, as are many other technologies. And the thing we get into is there's no single point estimate, because every project has unique characteristics, whether you're relying on natural resources, such as, how windy is it somewhere, or whether you're looking at what the site geology is and how much you have to compensate for that, or transmission in your construction. So we find the National Academy of Sciences, we find EIA, and there are studies out there that I think are very helpful and accurate. And third,
I believe
neutral.
the EIA has recently, in the last few years, actually stopped doing year-by-year reporting of these. And actually, we have a piece of legislation where we prepared in our office to try to reverse that. I think that was a very valuable part of the puzzle that's actually sort of ceased to exist and shouldn't have. Anyone else want to try to field?
I would, or if we're going down the line, it depends on who is using this information. I would disagree that the federal.
You want to bring that mic a little closer?
It depends on who is using that information. I would disagree, for example, that the government should use that information to develop an energy mix that they would then mandate. If, however, the nuclear industry or wind industry or the utilities use that information as a variable in the considerations of where they place their investments, then that's fine. So it just depends on who's using that information and what for.
Well, I recommended in my book that there should be a standing committee as part of the Scientific Advisory Board of the EPA on energy and climate, and I think that they have a pretty diverse representation on their Science Advisory Board. I've served on their Radiation Advisory Committee. They produce good reports generally, and I think that would probably be one possible venue. The National Academy could be another. You're not guaranteed.
So you'd like to institutionalize the report of the real levelized cost of electricity for whatever, as R&T proceeds on these different things, as we get better data for different classes of nuclear plants, whatever it is, to just have some third party sits there every year and says, okay, what does it look like this year with this year's cost of nickel and this year's cost of cement and everything that will cause you to re-estimate all the different things?
Well, Mr. Foster, cost is just one thing. I think energy and climate is a very complicated thing, and I think the public and Congress and the executive branch should have an annual report on energy and climate, which covers cost issues, which looks out at R&D questions, but which also looks at the marketplace, which looks at CO2 questions and whether we need to tighten CO2 regulations or loosen them and things are not as bad or worse than we thought. And so I think I think we need a panel with the adequate expertise and public confidence in its independence that would report to the public each year, and that has a requisite level of independence.
And I guess I'll...
Mr. Foster, with all due respect, I'm on in a different place, I'm afraid. You won't find a panel that can, as you put it, get it right for further into the future than this time next week. The costs of different energy sources, the cost of nuclear 10, 20 years in the future, no matter how sophisticated the models and how well-intentioned the panel, the only thing you can be sure about their forecasts is that they'll be wrong. What you need are systems that make the least damaging errors, systems that have the greatest degree of flexibility in responding to changes in events. You've got to get the principles right and not the prophecies, because we just don't have prophets that good.
I was referring to just this year's results, the actual true numbers for this year, which I think should be knowable on a level playing field.
History is much easier to deal with than the future, yes.
Gentleman's time's expired. Mr. Welch, do you have any questions right now? Or we're going to ask another round, so if you want to wait. Okay. Okay, we're going to have one more round of the witnesses. In thinking of terms of of the risk here and what's confidential, it occurs to me that there ought to be a discussion about the economics of nuclear power plants and what would be the effect. I'd like Mr. Bradford, Mr. Makajani. As a matter of fact, the whole panel might be able to answer this question. What will be the effect on the economics of nuclear power plants if we experience decades of relatively weak prices for natural gas that the Energy Information Administration is predicting? And this was reported in the March 11th issue of The Economist. So we're looking at decades of relatively weak prices for natural gas. What is going to be the effect, or what could be the effect of this on the economics of nuclear power plants?
It would be pretty devastating. I mean, because right now, new nuclear is looking to sell 12-cent kilowatt hours into a 5 or 6 cent market. That's what today's natural gas prices are producing in the power markets in those parts of the country that use power markets. The gap between the 5, 6 cents in those power markets and the 12 cents that's about the lowest responsible forecast I've seen for new nuclear is bigger than even loan guarantees can bridge. And so it would be hard to build nuclear plants at all in those parts of the country that use power markets. In those parts of the country that are regulated, where the costs can be charged to customers willy-nilly, you might still see a plant or two built. That would be primarily the Southeast. But at low gas prices, you won't see many.
Dr. Makajani?
Yeah, actually, much more than nuclear waste, the thing that killed nuclear power in the 80s and 90s was low gas prices. Everybody was, and in this decade, in the last decade, everybody was building natural gas power plants because they were cheaper than anything else. And
so
now,
if you have weak gas prices, what happens?
If you have weak gas prices and loan guarantees, you're going to have a high likelihood of default on the loan guarantee, especially for merchant plants where they have to sell their power output on the open marketplace. In a deregulated marketplace, they won't be able to sell their power. Or won't be able to sell some significant fraction of it, which will drive up the cost of the rest of it, because most of your cost in a nuclear plant is a fixed cost, whereas in a gas-fired power plant, most of your cost is in the fuel cost. And so you can afford to remain flexible.
Thank you, Doctor. Mr. Spencer, do you want to?
I think all things being equal, that's probably true. You decrease the demand for nuclear power, but all things will not be equal. And if we change the policies that would allow new technologies to be developed and brought to the marketplace, that might have an impact on it. And also, I think there's a case to be made that utilities may choose to just be more diversified, not to be so dependent on natural gas, because we can't guarantee that prices will remain low forever. And I think that's something that nuclear really does bring to bear. It's 100 years or 70 or 80 years of reliable, inexpensive power generation once you get those capital costs.
But do you think though that given these dynamics, would it be less likely that Wall Street would decide to get back into the nuclear game then?
Well, I think we're going to build some power plants regardless. How many?
Who's we?
The United States. I think the United States will build a handful, 5 or 6 or 7 nuclear power plants no matter what, because the Energy Policy Act of 2005 created enough subsidies or incentives or whatever we want to call them to make that worthwhile. If natural gas remains low, I don't know, we shouldn't build nuclear plants just for the fun of building them, nor should we build wind or solar for the fun of building them. But I do think that there's something to be said for nuclear in terms of it bringing predictable, affordable power for a good long time. And that, if we get the policy right, even with low gas prices, depending on how low and all those sorts of things, could yield a pretty good incentive to continue moving forward with some nuclear build.
Sir, if I could respond too, yeah. If we could absolutely predictably say that gas prices were going to remain very low and there'd be no carbon tax, my members would build gas. Because they, as I mentioned, they're very invested in these projects, and it would be imprudent for them to do it for stakeholders, shareholders, everybody, and they wouldn't make that mistake. But that when gas prices are low, we build more gas, the price spikes, and here we are. And that volatility is very difficult on customers and the economy. And so I think they will look at what are the forecasts, what are the best mix to protect them from both gas volatility and a carbon tax. But if they would be thrilled to know if you could tell them that it would be very low for a very long time.
I want to thank each of the panelists for weighing in on this, and so I go to Mr. Jordan in a second here. I raised a question because the Economist March 11th issue has a prediction from the Energy Information Administration that relates to decades of relatively weak prices. Decades, they say. So I'm glad that you all weighed in on this. Mr. Jordan.
Well, thank you, Mr. Chairman, and I appreciate that line of questioning too. And I think Ms. Cass, her last couple statements were telling in that she said your members would build gas plants if the price of gas was going to, they knew the price was going to stay low, and the carbon tax. So I mean, how much of it's driven by the idea that there's going to be cap and trade, there's going to be some carbon, that's got to be driving this move as, in my mind, up to a large degree as well.
Absolutely, and the uncertainty. If you see in the public utility filings where they debate this with their public utility commissions in a couple of the rate-regulated states, that's very much on their mind. Many of those states in the Southeast have had gas price shocks that have been very uncomfortable. And then also when they look at the potential for a carbon tax, that changes the game.
I'm just curious, what's the operating cost, if you can give me some idea, the comparison, operating cost for a nuclear facility and a coal or gas facility? I mean, and I understand it depends on the price of coal, the price of gas, but I mean, just kind of in a general sense.
Well, if you look at currently, and our plants are fully depreciated, as Jack mentioned, they are a 60-year asset right now. Fully depreciated, we're the lowest cost at 1.87 cents per kilowatt hour, and followed up by coal and then gas after that. And those two are very dependent upon fuel costs, so they occasionally will trade. But in the future, MIT did a study on the update of nuclear power, and they looked at the cost of nuclear versus coal and gas, and it was without carbon sequestration. If you gave them all favorable interest rates, they were in roughly the 5 to 6 cents per kilowatt range. If you add a carbon tax, then nuclear stays stable, and then the other two rise.
I'm also curious on the construction side, how much more expensive is a nuclear facility versus another type of facility?
It depends on size. Certainly, our capital cost is much higher. We tend to have a bigger installation. The smallest units we're considering right now are 1,100 kilowatts and up. 1,100 megawatts and up. Sorry, and we have all the safety systems and redundancy and and they are far more expensive on the capital front. But when you start adding some of the environmental controls and look at some of the coal plants with IGCC plants and some of the plants that would have carbon capture and sequestration, then they start coming into the capital range that we're in.
Does your agency take a position on subsidies for other energy forms of energy, wind, solar, ethanol?
We're just looking for a level playing field. We found that the loan guarantee program, we're happy with the way that it's structured, but we do need more loan volume, would be very effective for us. We actually believe that it's going to take the full energy mix, and in the current environment, our utilities, again, are also building wind farms, also building solar, and what is it going to take to bring all these technologies to bear so they can keep up with demand, but also meet the mandate for clean energy?
Mr. Spencer, I raised the Yucca Mountain issue in the previous round, and you had sort of brought that in front of the committee, and didn't give you a chance to talk about that. If you'd like to elaborate on the uncertainty that not having a place to put the waste, and the cost that you see that adding to potential investors' willingness to invest in these projects.
I think it's a substantial issue on a number of levels. First, in order to have a nuclear power plant license, we need to have a place to put the waste. Now, the Blue Ribbon Commission is supposed to give us that, but one of my fears is that by potentially killing Yucca Mountain before having a plan B in place, it could bring some uncertainty there, and that's real uncertainty that will have an impact on costs. Then there's the longer term impact that I think of having the government in charge of nuclear waste. It really removes the economic incentives for those who would have the most need to come up with a waste solution. The utilities, they're the ones who need a waste solution in order to sell their product. I think that putting more responsibility on the utilities to develop a nuclear waste solution, that includes Yucca Mountain as an alternative there, would help bring those same market pressures and downward price pressures to and competition both on the waste management side, but also on the nuclear technology side, because if you're responsible for your waste, then you start caring about how that waste is produced. Keeping the government in charge of that nuclear waste really, I think, is one of the detriments to really getting us to where we need to be on the nuclear front, that allows nuclear to be competitive with everything else, even absent carbon caps potentially.
Yeah. Thank you, Mr. Chairman.
Thank you. Chair recognizes Mr. Welch of Vermont.
I'm sorry I got here late. It's great to see Mr. Bradford from Vermont. Mr. Spencer, you probably testified about this, but how would we deal with the waste issue as you proposed it very succinctly, because I don't want to put my colleagues through hearing that again if you've answered it. And secondly, would it be a prerequisite to the future of nuclear power that be dealt with before plunging in with these huge investments?
I think we have a plan in place already where the waste goes to Yucca Mountain that works for the time being. But that doesn't give us the comprehensive, I think, long-term sustainability that we need.
But it's not working at Yucca Mountain.
Well, no, I think that it could work. I don't think there's anything that
no, well, that's my question. As you know.
Okay, let me try to answer your question in 30 seconds, which I'm not going to be able to do. Yeah. So red lights and then go on here. But here's what I think we need to do. The utilities should be in charge of their own nuclear waste. Once if they are in charge of that, then you start to create a marketplace for waste services. I think Yucca Mountain or some geologic repository somewhere should be critical to that. Geologic repository space would then be looked at as a finite commodity. As it fills up, that sends the signal out into the marketplace. You need to reprocess or do something else. I think that there's a way that we can introduce market forces into waste management that would get the politics out and allow us to come up with a long-term solution.
All right. So would that have to be done first, and then that would make it possible for the to proceed and make non-government-based, non-subsidized decisions about investing in these massive capital assets?
I think that having a sustainable solution to nuclear waste will allow us to develop a long-term economically viable nuclear industry. I don't think that we need to have that solution before we build or permit a new power plant.
Mr. Marchigiani? Yeah.
Thank you, Mr. Welch. The Yucca Mountain question, from the point of view of the utilities, was really settled, at least as it was thought then, by the 1982 Nuclear Waste Policy Act. Ratepayers paid 1/10 of a cent a kilowatt hour, and utilities had some certainty When that certainty didn't come to pass, they sued the government, and the taxpayer is actually picking up the cost, at least in those suits that have been successful. And I believe that the government did violate its contracts, and so the taxpayers are paying for the additional storage that will be required, and that liability is actually mounting. I don't think the industry is looking to significant extra costs because of this default, because the taxpayers are now on the hook for that money, and it's not coming out of the nuclear waste fund. I am a supporter of a deep geologic repository, but I happen to think that Yucca Mountain, in my opinion, has been the worst single site that has been investigated in this country.
Well, yeah, I'm going to stop you there. We don't need to go into it, but because those arguments are inevitable. Whatever, it's a huge NIMBY issue. Wherever you're going to be, there's going to be enormous opposition. And it really has raised the question in my mind as to whether or not there's a political capacity on the part of Congress to actually have a legislative outcome rather than have it be endless fights. Let me go to Mr. Bradford. Your view on this?
Well, there's a lot to be said for Mr. Spencer's view, and I wish the program had unfolded that way from the beginning. In many ways, the commitment to take the nuclear waste that the federal government has made, which is unique to the nuclear industry. After all, the federal government doesn't offer to take the waste from any other industry, could be said to be one of the largest of all the subsidies that was given to nuclear energy, and it's played out very badly for them. But it is a commitment that's in place now, and it's hard to see how we could develop a deep geological repository, all the transportation necessary to get it there, without a central role of some sort for the government. Not necessarily the Department of Energy, conceivably a differently constituted authority would be more successessful. I just don't see us able to get from where we are to market principles today, although it would perhaps have been very desirable to have been there from the beginning. With regard to the role of a waste repository in the context of new reactors, I agree that you can't really make a case that 6 or 7 more plants change the nature of the waste dilemma in any fundamental way anymore. In fact, it's less than operating the existing plants for additional years. We're going to be using pools and dry casks, and the only serious question is whether we centralize the dry cask storage somewhere in the next decade or two. I do think it's fair to say that before a major expansion beyond these so-called first mover plants, it's reasonable to seek a higher degree of assurance than we have now that we know where the waste is going.
Okay, thank you. I yield back.
I thank the gentleman. Without objection, I'm going to ask that this article from The Economist, March 11th, issue of The Economist, which says the Energy Information Administration, the statistical arm of America's Department of Energy, predicts decades of relatively weak prices for gas, that this be included in the hearing record. And I want to thank this panel. I think that it's been an important discussion. The market economics are not a small matter here in trying to determine which way this might go. And I want to thank each of you for participating. So we're going to go to the next panel now. Thank you, Mr. Bradford, Dr. Marcagiani, Mr. Spencer, Ms. Cass. Thank you. We're going to take a 3-minute recess until the room is prepared for the second panel.
sit down. Not enough of us. We need extras. Mr. Cooper. Yeah, I enjoy looking at your charts.
I sent you another version. It's the underlying chart that CEO. Sorry.
The chair.
Yeah.
That's why. That's easy. I got
They try to do too much.
Yeah, I've talked.
Again, we're from the subcommittee.
Oh, I'm sorry. I'm ignoring you again there. Sorry.
Okay, guys.
That buzzer does not signify a meltdown. We're waiting. Okay. The committee's going to come to order. I want to thank all of you who are present. I'm going to introduce the second panel of witnesses and begin with Dr. Mark Cooper. Thank you for being here. Dr. Cooper is a senior fellow for economic analysis at the Institute for Energy and Environment at Vermont Law School. He's the author of dozens of articles and 6 books on energy, technology, and telecommunications. He's provided expert testimony in over 250 cases for public interest clients, including state attorneys general and citizen interveners before state and federal agencies and courts. Dr. Cooper received his Ph.D. from Yale University. Mr. Henry Sokolowski, welcome. He's Executive Director of the Nonproliferation Policy Education Center from 1989 to 1993. Mr. Sokolowski served in the Bush administration in the Office of the Secretary for Defense. Previously, he served as Senior Military Legislative Aide to Senator Dan Quayle and as Special Assistant on Nuclear Energy Matters to Senator Gordon Humphrey. He's also had an association with the Heritage Foundation and the Hoover Institution. Mr. Sokolowski is author and editor of several books and numerous papers. Mr. Richard Caperton, thank you for being here, is energy policy analyst at the Center for American Progress, where he's concentrated on the analysis of financing mechanism and incentive structures intended to encourage clean energy technology. Previously, he's worked at the National Rural Electric Cooperative Association. He's a graduate of Pomona College and Georgetown University's McDonough School of Business. Mr. Michael Scott, thank you for being here. He's Managing Director at the investment bank Miller, Buckfire, and heads its United States Government Advisory Practice. Previously, Mr. Scott was Senior Advisor to Chairman Christopher Cox. Before that, he was Managing Director and head of the U.S. government entities at Bank of America Securities, where he advised companies on federal loan guarantees to build a proposed Alaska natural gas pipeline, as well as those associated with advanced energy facilities, including the Energy Policy Act of 2005. Before that, Mr. Scott served for 5 years at the U.S. Department of Treasury as Senior Advisor. There he was Principal Architect of the Federal Credit Policy. He negotiated and structured programs that provided federal credit to a wide range of industries, including airlines, banks, rural telecommunications, and energy companies. He was also responsible for Treasury's role on the Air Transportation Stabilization Board, where he structured and negotiated loan guarantees supporting the $429 million unsecured loan to America West Airlines. And finally, Mr. Christopher Guth. is Vice President for Policy at the United States Chamber of Commerce Institute for 21st Century Energy. Thank you for being here. Previously, Mr. Guth served as the Deputy Assistant Secretary for Nuclear Energy at the U.S. Department of Energy, excuse me, and represented the Bush administration during the drafting of the Energy Policy Act of 2005. Before that, he was Legislative Director for former Congressman Bob Barr. He is a graduate of Syracuse University School of Law and University of California at Santa Barbara. Again, I want to thank each and every one of the witnesses for being here. This is indeed a distinguished panel, as was our previous panel. I want to thank you and also tell you that it is the policy of our Committee on Oversight and Government Reform to swear in all witnesses before they testify. I would ask that you rise. Please raise your right hand. Do you solemnly swear to tell the truth, the whole truth, and nothing but the truth? I do. Thank you. Let the record reflect that each of the witnesses answered in the affirmative. I would ask that each witness give a brief summary of your testimony. Please try to keep the summary under 5 minutes in duration. Your entire written statement will be included in the record of the hearing. Dr. Cooper, you're our first witness on the panel. I would ask that you proceed.
Thank you, Mr. Chairman, members of the committee. The fundamental economics of nuclear power should determine whether a new generation of reactors is constructed in the United States. In my testimony, I show the basic supply and demand fundamentals of new nuclear reactor economics that have led Wall Street to refuse to put up the funds to finance new reactors, and why policymakers in Washington should not force taxpayers to do what the capital markets will not. I answer 4 questions posed to me by the committee. First, cost overruns in the construction of nuclear power plants are not a thing of the past. They are a recurring present-day problem. Cost escalation and overruns afflicted the industry during the 1970s and 80s, when the final reactors built were 7 times as expensive as the initial cost estimates for that round of construction. The escalation of projected costs since the beginning of the so-called nuclear renaissance has rivaled that historical experience. In less than a decade, the projected costs have more than quadrupled. The causes of this escalation are well known. Reactor design is complex, site-specific, and non-standardized. In extremely large, complex mega-projects that are dependent upon sequential and complementary activities, delays tend to escalate into interruptions. These one-of-a-kind specialized projects have few suppliers, so any interruption or delay in delivery cannot be easily accommodated, and any increase in demand or disruption in supply sends the cost of components skyrocketing. Material costs have been rising, and skilled labor is in short supply. The energy-intensive materials and construction processes that are involved in nuclear reactors entail processes that are likely to be deeply affected by any carbon policy, so the cost escalation will be built in. The current costs of nuclear reactors are extremely expensive, uneconomic, and those costs are likely to escalate, not decline, if these reactors are ever built. Second, we do not currently have such demand for electric power plants that we need to rush into the construction of multiple nuclear reactors. We have time to experiment and to see what does and doesn't work before we proceed. Whether or not climate policy is enacted, efficiency and several widely available renewables are substantially less expensive than nuclear reactors. They can push out any need for these facilities for decades. So the rational approach is to build the low-cost, low-hanging fruit available and take the time to develop alternative low-cost options. Third, Wall Street won't invest in nuclear power plants for very good reasons. In addition to the supply and demand factors I have already mentioned, these plants are subject to dozens of risks: technology risk, policy risk, regulatory risk, execution risk, marketplace risk, which make them a bad investment. A combination of these risks are what created the financial disaster in the last round of nuclear construction. Given these risks, Moody's is right to have declared investments in these projects a bet-the-farm decision, and other analysts want a return on investment, a risk premium, 2 or 3 times as large as the normal premium. That is why Wall Street will not invest in these projects. Finally,
Increased loan guarantees for nuclear power plants misdirect resources that could be better used for energy efficiency and renewables. Loan guarantees induce utilities to develop the wrong resources. They choose high-cost, high-risk, capital-intensive projects that pump up their rate base. That's how they make money. And leave behind the more economic, less costly facilities. The result is a dramatic increase in the consumer's bill. You heard a suggestion that Georgia Power Southern Company estimates a $15 to $20 million a year savings from the loan guarantee. The excess cost of those facilities is between $500 million and $1 billion a year. It's a bad deal for the ratepayer. The rejection of financial markets that has afflicted nuclear reactors is not an example of market failure. It is, in fact, a market success, an instance, and frankly there have been too few lately, where the marketplace has properly evaluated risk and refuses to put private capital on the table. If Congress were to override that decision, ignore the indication of Wall Street, it would place ratepayers and taxpayers at severe risk that I think would mount in the end to trillions, not billions or even hundred billions of dollars. Thank you.
I want to make sure that for the record that I have the pronunciation of your name. The copy that I have in front of me says Sokolowski. Now, your name card says Sokolsky. Would you help me out here?
I kind of prefer the latter.
Okay, well, that's what it is. It's Sokolsky. Well, you know, where I'm from in Cleveland, Sokolowski's a well-known name, and the copy here did say Sokolowski, but it's Mr. Sokolsky, and Vitam Vas. Welcome.
Okay. I don't make helicopters either.
Welcome.
Right. Thank you, Mr. Chairman and members of the committee, for allowing me to testify before you today on whether or not creating additional federal loan guarantees for new civilian nuclear energy plants is advisable. My short answer is it's a bad idea. This is based on...
Bring that mic a little closer, please.
Even closer? Okay. There we go. This is based on the findings of a 2-year study my center just completed on nuclear economics, the key findings of which I'm releasing today. I'd ask the committee if I could present this as an exhibit along with 2 other short op-eds.
So ordered, without objection.
In general, my views are like that of many of the panelists you've already heard. I think the key problem new nuclear power plants have is that to become economically competitive, they have to reduce their capital construction costs considerably. I think piling on more government financial incentives beyond those you have already voted for and approved to promote commercial deployment of nuclear power is only likely to reduce market pressures on the industry to meet this critical goal of reducing capital costs. This then brings me to the committee's 4 questions. Are cost overruns in the construction of nuclear power plants a thing of the past? I think if we understand what's happening in Finland, France, Canada, and the U.S., the short answer is no. In addition to the Finnish and American cases you've already heard, we have the French case of EDF struggling to keep construction of a similar plant to that being made in Finland on schedule, and in France, the project's now running more than 20% over budget and at least 2 years behind schedule. In Canada, the government of Ontario put its power plans on the table to build 2 large reactors and decided to put them on hold after receiving a $26 billion bid that was nearly 4 times higher than the $7 billion the government originally set aside for the project only 2 years before. As you've heard, in the U.S., projects at an advanced stage of planning have seen their cost projections soar 4-fold in less than a decade and are still rising. Why won't Wall Street invest in nuclear power plants, and why does Moody's call them bet the farm investment? 3 reasons. First, projections of new nuclear power plant construction costs are far higher today than several non-nuclear alternatives, while the long-term requirements for ever larger numbers of baseload generators, nuclear or non-nuclear, could easily decline as a result of energy technology innovations. Betting nuclear power will make money through 2080, when nuclear power plants clearly cost far more to build now and take far longer to construct than cheaper alternatives, is too large of a gamble for private investors. Like U.S. spending on canals in the early 1800s, which was undercut by the advent of steam locomotives, the risk of investing in expensive nuclear plants is that energy innovations in the storage, generation, distribution, or use of electricity could easily wipe out the value of whatever commercial nuclear investments are made. You've already heard about the history and how unkind it's been to nuclear power projects in the past. I think this is the reason why the nuclear industry is seeking more federal loan guarantees. Finally, the value of federal loan guarantees is so uncertain, and the ability of the utilities to cover their risks with their own capital so low, that even with loan guarantees, private investors are leery. I would like to associate myself with the recommendations already made that you really need to make sure that Congress demands that DOE supply Congress with answers to the questions about the cost of these loan subsidy fees. That you need to get clear. Without that, the private industry is going to be very leery about getting involved, even with loan guarantees. You asked, do increased loan guarantees for nuclear power plants misdirect resources that could be better used for energy efficiency and renewable power projects? I will keep my comments short. The short answer is yes. Experience with synfuel, breeder reactors, ethanol mandates, and the like should teach us all enough not to repeat. Finally, do increased loan guarantees for nuclear power plants misdirect United States financial resources for the benefit of other countries? Here, the short answer, again, is yes. AREVA and EDF, who design and build the evolutionary power reactors, planned for the U.S., are key beneficiaries, along with Hitachi and Toshiba, the Japanese firms who have teamed up with Westinghouse and General Electric, and who now have a controlling or a significant ownership portion of these companies. Urenco, a European consortium that is building an enrichment plant in New Mexico, also stands to benefit, as does AREVA, which is building enrichment plants in Idaho. Almost all of the manufacturing jobs associated with these plants' construction will either be done abroad or in factories owned by these firms. Bottom line, if renewable natural gas and carbon prices were all clearly rising, and the technologies for electricity storage, distribution were static, the case for government intervention in promoting commercial nuclear power, although wrong in principle and practice, would at least be stronger. Yet, just the opposite seems to be the case. I believe getting into this further than we already have is risky business, and pure risk at that. I think the losses are quite possible, and the gains simply are not there. Thank you very much.
Thank you very much, Mr. Tsiolkovsky. Mr. Caperton, you may proceed.
Thank you, Mr. Chairman.
And keep that mic close so we can hear you. Thanks.
Sure. Members of the committee, thank you for inviting me to testify before you this afternoon. My name is Richard Caperton. I'm a policy analyst on the energy team at the Center for American Progress, a think tank here in Washington, D.C. As you know, nuclear power currently generates about 1/5 of American electricity. Nuclear power is a low-carbon, baseload power source that will continue to play an important role in America's clean energy future. It's vitally important that we explore all potential energy sources that reduce our carbon emissions, but this should not force taxpayers to bear inordinate amounts of risk. The President has proposed incentivizing new nuclear construction by issuing $54 billion in loan guarantees. The terms of these guarantees must include adequate protections for taxpayers. Most important, the credit subsidy fee must be properly calculated. In my comments today, I will describe what the credit subsidy fee is, how it's calculated, and what an appropriate fee might be. First slide, please. When the government issues a loan guarantee, they're committing to use taxpayer money to pay back the loan if the borrower defaults. The government must account for the increased risk it now bears, which it does by calculating the credit subsidy cost. In the Nuclear Loan Guarantee Program, the credit subsidy cost is paid by the borrower in the form of a credit subsidy fee. If the fee charged is too low, it will increase the risk to taxpayers. At the same time, if the fee charge is too high, it will unnecessarily decrease the number of reactors financed. Credit subsidy cost is calculated by a proprietary model at the Office of Management and Budget. And although the actual calculation is highly technical, the basis for the calculation is straightforward. Essentially, the credit subsidy cost is the present value of the expected payouts that the government will have to make on the loan if the utility should default. Next slide, please. There are 5 basic steps in calculating the credit subsidy fee. First, determine the likelihood that the builder of the reactor won't be able to pay back the loan, the default rate. Second, determine the percentage of the total reactor costs that will be covered by the loan guarantee. And in the nuclear program, the guarantee can cover up to 80% of the total cost of the project. Third, determine the amount of the total costs that will be recovered in the event that the borrower defaults and the reactor is sold in liquidation, the recovery rate. The first 3 steps give a total payout that the U.S. government will have to make. Spread these payouts over the lifetime of the loan based on when expected defaults will occur. And finally, discount the payouts in future years to determine a present value of the total payouts. This is the credit subsidy fee. Each of these steps requires an input that can vary widely based on technical details, which makes precise calculations very difficult. Estimates of what this fee should be run the gamut from 1% or less to 30% or more of the total loan guarantee. Faced with these widely divergent estimates, I've done some simple calculations of the credit subsidy cost given certain inputs. The 2 most important, of course, every project is different and should be evaluated independently, but widely publicized data from CBO, GAO, and Standard & Poor's indicates that the expected rate for generic new nuclear reactors. Simple calculations indicate that the credit subsidy fee on a nuclear loan guarantee program that has the predicted characteristics, that is 50% default and recovery rates, should be about 10% of the total value of the guaranteed loan. The appropriate fee goes up as the expected default rate goes up and as the recovery rate goes down. This table shows what the credit subsidy fee should be given any combination of expected default and recovery rates. And to put this in perspective, each 1% of the entire $54 billion in loan guarantees that the President has proposed represents $540 million. That is, if DOE undercharges loan guarantee recipients by just 1%, the President's proposal will cost taxpayers $500 million. It's impossible to say what the credit subsidy fee on a specific loan guarantee should be without looking at details of specific nuclear projects. The administration must keep in mind, however, that credit subsidy fees should be set at a rate that protects taxpayers, not at an artificially low rate as a handout to private businesses. DOE will only be able to protect taxpayers from bearing the risk of new nuclear reactors if it charges an accurate credit subsidy fee. Thank you.
Thank you for your testimony, Mr. Scott. Chairman Kucinich, Ranking Member Jordan, members of the committee, thank you for the opportunity to testify here today. My name is Michael Scott, and I head the U.S. government investment banking business at Miller Buckfire. In creating Title 17, Congress recognized that there was a private market failure to finance new clean energy technologies that reduce greenhouse gas emissions, and that this market failure encompassed a broad range of technologies. Congress also recognized that the importance of getting these clean technologies constructed and into operation. However, given the cost of the various eligible technologies, the U.S. government was unlikely to have the budget dollars necessary to appropriate to Title 17 projects in amounts sufficient to achieve the purposes of the program. So Congress provided a unique path among federal credit programs to finance enough projects to get a technology into general use, with the private sector paying the full cost of the guarantees. Prior to the Federal Credit Reform Act, the costs of federal credit programs were only evaluated and appropriated at the time of default. This approach did not provide legislators or policymakers with the true budget impact of a federal credit program, and was inconsistent with the budgeting process in the non-credit spending programs of the U.S. government. The Federal Credit Reform Act is designed to calculate the net present value of the long-term cost to the U.S. government of any federal credit program. Properly and faithfully implemented, the Federal Credit Reform Act considers all of the cash flows over the entire lifetime of the loan, including defaults, fees, recoveries, as well as contractual and structural protections. With potential tenors of 30 years, this entire lifetime of the loan analysis is very important and substantially different from the scoring of non-credit spending programs of the U.S. government that do not analyze, measure, or otherwise calculate the cost beyond the 10-year budget window. Each project is subjected to extensive due diligence and statutory and rule requirements that protect the taxpayer and fully price the risk that would be assumed in providing a loan guarantee. The President and Congress have a very powerful policy tool in Title 17 that is unique and important in the current economic environment, especially with the U.S. government facing the stresses and difficult choices involved with our significant budget deficits. Title 17 can drive economic growth through the development of clean energy infrastructure projects that are built and fully paid for by the private sector, provide significant short-term and long-term construction and manufacturing jobs, provide long-term operating jobs, promote the development of new U.S.-based manufacturing, particularly significant in the case of manufacturing that will develop from a robust new nuclear build, develop environmentally clean and secure domestic energy supply capacity, particularly in the case of carbon-free baseload generation from new nuclear, correct the private market failure to finance clean and innovative energy technologies, and finally, provide well-qualified project sponsors with confidence that credible projects can receive a federal loan guarantee, which is an important signal for private sector project sponsors to pursue these substantial investments because of the upfront cost that they bear before any application and significantly before any closing on a federal loan guarantee. Significantly, the President does not need new legislative authority or new appropriations to make Title 17 work, as Title 17 provides for the credit subsidy and the administrative costs to be fully paid for by the borrower and substitutes the borrower payments for the appropriations. This means that the federal budget is not affected by the issuance of the loan guarantees under Section 1703, and that the level of risk assumed by the U.S. government is fully compensated for as measured by the Federal Credit Reform Act. The calculation for this risk is completed in the same manner as if this was a traditional federal credit program where the U.S. government paid the credit subsidy costs. In summary, Title 17 provides a means to achieve the priorities and policies of the President and Congress pertaining to jobs, the economy, clean and secure domestic energy capacity, and the environment. It does so through a clean energy infrastructure build that is fully funded by the private sector. This build will also be the engine of growth in the investments that develop our domestic supply chain manufacturing base in supporting industries such as iron and steel. The key to all of this is operationalizing Title 17. The President and his administration can accomplish these critical objectives by removing the current improper rule-based impediments, elimination of the arbitrary maximum loan guarantee, authority levels, and calculating the credit subsidy in a manner that is faithful to the statute. I am pleased to answer any questions that you may have. Thank you. Thank you very much, Mr. Scott. Mr. Guth, please proceed.
Thank you, Chairman Kucinich, Ranking Member Jordan, and thank you for the opportunity to contribute to this discussion today. I serve as the Vice President for Policy and the Managing Director at the Institute for 21st Century Energy, an affiliate of the U.S. Chamber of Commerce. The Chamber is the world's largest business federation, representing the interests of more than 3 million businesses and organizations of every size, sector, and region. The underlying issue presented at this hearing is a valid one. Is the federal government properly balancing the protection of the American taxpayers with its joint responsibility to improve our nation's energy security? I think it's important to remember how this program came to exist over the past 4 years. The idea of a loan guarantee program originated in Congress with the intent to accelerate private investment into new and clean energy technologies. It was the unanimous, bipartisan, and bicameral voice of the 4 conference managers that ensured inclusion of the loan guarantee program in EPACT, or the Energy Policy Act 2005, fully acknowledging the importance of this program to the building of new nuclear facilities. This program initially elicited skepticism from senior leaders of the Bush administration. Frankly, many had doubts about whether the government possessed the necessary experts or understanding of capital markets to sufficiently protect the taxpayer. However, building on the Federal Credit Reform Act and OMB guidance, DOE sought to create a program centered around a rigorous review of proposed projects that would utilize every possible resource to minimize taxpayer exposure. DOE spent the next 3 years standing up the Loan Guarantee Office, staffing it with esteemed subject matter experts who had spent entire careers in project finance, risk mitigation, and lending. They utilized the expertise of credit agencies, commercial lenders, engineering contractors, and legal consultants, to name a few, ultimately producing the final rule this past December. Spanning 2 administrations, DOE, the Department of Treasury, and OMB all exerted significant input and oversight into the evolution of the final rule. Additionally, Congress has played, as this hearing demonstrates, and continues to play, a significant role by way of authorization and oversight. In fact, many senior congressional leaders have taken issue with the amount of time it has taken to begin issuing guarantees, which I think is a testament to the careful and deliberate nature underpinning the implementation of this program. In measuring taxpayer risk, I think it is very important to acknowledge and understand the magnitude of risk a company accepts when it decides to build a new reactor. Even with a federal guarantee, each company understands that if a new project were to actually default, it would likely be the demise of that business. When a company does make a decision to build a new reactor, it will not be until it has completed an exhaustive review of its own risk, which by rule is greater than the government's, and has determined that risk is sufficiently minimized to effectively, as has been stated before, bet the company on the project. The federal government has a greater responsibility to Americans than just to minimize their exposure to risk. It must also craft and implement broader policies that further the taxpayer's interests while also mitigating risk. Energy touches on every single business and household every day, and fostering the deployment of clean energy technologies is a major component of fulfilling the government's obligation, and the DOE loan guarantees are an integral tool in doing this. To date, the Nuclear Regulatory Commission has received a net of 26 license applications to build new nuclear units. While the first license is not expected to be issued until next year, industry has already invested in excess of $5 billion in preparation of building new reactors and generated more than 15,000 new jobs. If all 26 of these proposed reactors are built, we estimate that as many as 240,000 direct and indirect jobs will be created by 2030, jobs paying about 36% above the local average. Nuclear plants each purchase $430 million in goods and services from the surrounding community and provide $40 million in salaries and nearly $100 million in tax revenues. That's each unit or each plant. This is one of the primary reasons for why nuclear power polls highest in communities that already host nuclear facilities. And it is worth mentioning that the nation's support for nuclear power has climbed to 62% in Gallup's annual survey, the highest mark since it began asking the question in 1994. While the legislative and regulatory focus in Washington continues to be on greenhouse gases, it's important to acknowledge that nuclear power not only emits no greenhouse gases, it emits no hazardous air emissions at all. Other countries are well aware of the economic and environmental benefits of nuclear power. 55 reactors today are currently under construction around the world in 13 countries, with another 140 planned in the very near future. The International Atomic Energy Agency estimates that there could be up to 25 nations with operating reactors by 2030 that do not currently have a nuclear program. Yet, this country hasn't licensed the operation of a new reactor in over 30 years. Many opponents of nuclear power seize on announcements of other countries making investments in renewable power generation, but usually fail to note that these investments are about a fraction of what the world community is making in new nuclear generation. So what is it that these countries know the United States seems to be missing? These countries realize that nuclear power must play an increasing role in meeting projected increases in demand for power, in reducing greenhouse gas and hazardous air emissions, and doing so in an efficient, economical, and reliable manner. While the governments in many of these countries directly finance the construction of new reactors, we rely predominantly on investor-owned utilities, as well as municipal and cooperative ventures to do it. However, without a federal loan guarantee program to help secure financing for the first bunch of these new reactors, we will likely not see enough nuclear generation to even make up for the lost generation of retiring reactors over the next 30 years. It has become fashionable to argue that the United States is missing the proverbial boat on the clean energy revolution around the world. While it is almost never the speaker's intention to include nuclear power in this mix, they are correct that every year that goes by while we debate whether to support new nuclear builds, we are missing out on the largest component of the global clean energy market. Thank you.
I thank the gentleman and each member of the panel. It's much appreciated your presence here. Having had the chance to review your testimony, this, I have to say, it's greatly valued, and I think it will be very helpful for members of the subcommittee to read and review carefully the testimony of each and every individual here. I'd like to go to the members of the panel now and ask, what's your opinion of a credit subsidy fee that's secret, not disclosed to the taxpayers? Mr. Cooper.
Well, it's quite remarkable that this administration, which had prided itself on transparency and open government, would come forward and suggest that something as important as the liability to which taxpayers are being exposed will be a trade secret between the Department of Energy and those utilities. As Mr. Bradford pointed out, in theory, the Public Service Commission might get a chance to look at that or might not, and that will influence the rates people pay, but it would seem to be a desire to hide the truth, which is that the taxpayer is being hosed in these transactions.
Mr. Sokolsky.
I don't know. I'd ask for my money back. I wouldn't make the loan. You got to know that. You are the executors of this effort as it is. I mean, we're not talking about doing this or not doing this. We're asking, do we do more of this? We're in the business now of doing it. I'd say you need to really get the facts and figures on what we're doing before you pile on more.
Mr. Caperton.
There are three things that are secret now. The model that's used to calculate the credit subsidy fee, the inputs to it for each loan guarantee, and the results of the model, what that fee actually is. I can certainly see that the first of those, the model, should be made public, and the fee should likely be made public. There would certainly be trade secrets involved in what goes into the model, so I could see elements of that being kept proprietary.
You know, I studied your testimony, and you actually did a kind of a reverse engineering of the Office of Budget and Management model by saying that it's essentially the present-day value of the expected payouts that the government will have to make on a loan if the utility should default.
That's correct.
Okay. Mr. Scott.
It's actually unnecessary for them not to disclose it because the applicant will end up disclosing it in SEC filings anyway. So it's going to become public, assuming that there's a SEC applicant. And if you're doing that, you might as well do it for all the projects.
So it's an interesting point you raise, and that is if OMB says it's proprietary, does the SEC give the applicant a waiver on that?
I doubt that they would, and I don't think any of the companies would.
It's an interesting question. Yeah. Mr. Guth.
I think it's important to note that Congress does have access to this. The appropriators who create the authorization for this have asked for annual reports, and they're fully informed as to what this is. And I'm sure that, well, I don't want to speak on behalf of the department, but when I was there, we never would not disclose said information to the Congress. Secondly, I think the model itself should definitely be disclosed. I think that created much consternation over the last 2 years that nobody in any industry could figure out what OMB was doing. And frankly, those of us who worked in other agencies couldn't figure out what OMB was doing. And Congress certainly couldn't figure out what OMB was doing.
Well, let me ask you, bondholders and shareholders, is there a legitimate reason for keeping the credit subsidy cost from them?
The ultimate cost itself?
The credit subsidy cost. I mean, should bondholders and shareholders have a right to that information?
This is one of those, when did you stop beating your wife questions? Because on its face, absolutely not. Everything should be transparent. But the question is what does a specific number, in addition to other information, actually lead you to? I mean, this issue has come up more in the non-nuclear loan guarantees than it has in the nuclear loan guarantees. Because as other competing power generation sponsors or applicants have gone through this process, they don't want to necessarily have their information disclosed to other competitors.
Surely you recognize that this Congress has had brought before it in the last year many issues where shareholders were not adequately informed of the transactions that were being undertaken by the management of their companies. That's why I raised the issue.
And as I said, I mean, on its face, the number, everything should be transparent. It's in what context and what other information is disclosed. And certainly in this case, Congress is fully informed as to what the number, the process is, certainly as well as anyone.
Can hope so. Now, I mean, it reminds me of an old story about how we have a system of checks and balances, or the administration writes the checks and Congress doesn't know what the balance is. Now, for the panel, does the Department of Energy's track record justify public confidence in its ability to fairly and accurately price the value of the credit subsidy of loan guarantees to the nuclear industry in order to protect taxpayers from a large bailout of the nuclear power industry? And is the Department of Energy more likely to overestimate the cost of the credit subsidy, or are they likely to underestimate it? Mr. Cooper.
I don't think the Department of Energy has much of a record. I've been around long enough to remember the Synfuels program, and we were adamantly opposed to that. The notion that the Department of Energy is substituting its judgment for the judgment of Wall Street, maybe hiring some consultants. There are a lot of them out of work these days to help them work through some of these numbers. From my point of view, the program was a small program. They should have left bad enough alone. The administration has thrown a lot more money into the pot. We hear rumors of unlimited loan guarantees. In the end, this could make the Synfuels program look like a walk in the park.
Mr. Sokolsky, do you want to respond to that?
Synfuels, the breeder reactor, the mandates for ethanol where they miscalculated suggest someone needs to come up with the alternative record where they've done well. I think the other thing is, my understanding is the number of analysts working due diligence within DOE is a pale reflection of the numbers you'd find in a competent, reputable large bank. Now, I don't think a reputable large bank has been doing so well. And so I just wonder, final point, there could be a conflict of interest. The DOE was intimately involved in not just promoting, but helping to pay for the design of the reactors we're talking about seeing built in the case of Westinghouse. So I don't think that's the place you want to have your analysis done.
Thank you. I'd like to just get brief answers from the rest of the panelists, and then we're going to go to Mr. Jordan. Go ahead.
Sure. This is a unique program, and so I don't know how much previous DOE experience is going to be effective in judging their ability on this one. But the Congressional Budget Office has clearly stated that they think DOE will underestimate the cost of these loans by at least 1% for a variety of reasons, including that utilities who are borrowing this money, who are applying for the guarantees, if they think it's a bad deal, they won't take the guarantee. So only borrowers who think it's a good deal will take the guarantee.
Thank you. Mr. Scott.
So in this particular program today, we don't have much of a record, and we won't for a number of years with respect to any closing on a nuclear, because the loan guarantee actually won't close for 2 to 3 years before they fulfill the conditions precedent. And it's actually at that point that OMB calculates the credit subsidy. Historically, if you go back to other programs that are targeted towards corporate America, and the ATSB after the airline program after 9/11, OMB had estimated, and CBO had estimated, between a 30 and 35% credit subsidy rate. We ended up making 6 loan guarantees. At the end of the program, we netted about $300 million in fees after three technical defaults and one $20 million compromise. So that brings the credit subsidy down to -18%. So the track record under the Federal Credit Reform Act is actually fairly good at predicting the costs. I'm actually less concerned about OMB's ability to accurately measure the costs than some of the other participants.
I agree that since most of the examples that have been cited on this panel have been prior to the passage of FCRA, which was 1990, which has completely reshaped the loan guarantee process, agency or government-wide, whether it's USDA, whether it's Exim Bank, whether it's DOE.
Recognize Mr. Jordan.
Thank you, Mr. Chairman. I'm just interested in the panel, particularly our first three. I think it's kind of interesting. The chamber supports the program, but the academic and the two think tanks are opposed to it. So not something you always see. And the Bush administration individual, I believe, is somewhat supportive based on what I gathered. And I understand various reasons and things associated with all that. But for our first three in particular, who talked about how bad this program was and shouldn't be in it, and market forces should be at work, et cetera, where are you at on taxpayer assistance, subsidies, loan guarantees, whatever, for other energy, other areas of energy, other resources? I think Mr. Sokolsky's statement was, you said that loan misdirect resources. So do you support subsidies for ethanol, biodiesel, solar panel? And we'll start with Mr. Cooper, and we'll just go down the whole panel.
If I could get a subsidy-free energy environment, I would take it. I would prefer to live there than in the mess I've got here. But since I can't, and the interesting thing in the previous panel, people missed the biggest subsidy of all, which is the Price-Anderson limit on liability to the industry. And so you have you have the federal commitment to waste, which was pointed out as a subsidy to the industry. And so you've got embedded subsidies all over the place. So I would rather talk about the principles by which subsidies should be awarded to various sectors. And the principles ought to apply to all the technologies. So one, the public policy should target an identifiable market failure. If you can't show me the market failure, then the government shouldn't be in the policy business. Let the market do it. Two, we should have a level playing field. And we haven't had one in the energy sector for an awfully long time. Three, the policy outcomes should be very clear. And as a consumer advocate, I like least cost. I like biggest bang for the buck. Diversity also is a good proposition. You've heard people speak to that. Fourth, there has to be fiscal responsibility. And as I see the loan guarantee programming being rolled out, it would appear to be that the sky's the limit, especially when I can't have secrets about the cost. And fifth, there has to be administrative accountability. Given that I have to live in an environment that's riddled with subsidies, I have to start making sure that they work for the public interest.
My grandmother had an expression for answering questions like that. She would say, "Enough already. We're up to our gills in this. This country's becoming a little broke. I think we need to stop. We need to stop this." We made a lot of mistakes, in my opinion, in bailing out companies we knew that were failing. They should have maybe used a little money to let them fail gracefully, but not save them. Two more comments.
No disagreement from the chairman and the ranking member on that.
Say again?
No disagreement from the chairman and the ranking
member on that.
that.
Well, there oughtn't to be amongst Americans on that. We're in trouble, sir.
I agree.
Now, it seems to me two other comments that might add some value. First, when I get principled environmentalists in a room who are economists, they say things like you heard, but even further. They join with fiscal conservatives in saying subsidies, even for wind, solar, etc., will hurt their cause. And the reason why is when you put the subsidies out there, the biggest pigs, coal, nuclear, are going to not only eat the most, but they're going to set the rules in that playpen for a long time. You need to experiment. So that's the last thing you want. Last comment. The only role for government, and it's why we have the Department of Energy, and it's a problem because it's not a great actor in my opinion, is that state regulations don't allow people to capture the rents associated with fuel efficiency in your mind, and that's the reason the government does it. We don't do a great job of it. I think regulatory reform would go a long, long way in solving that problem. I suppose I should close on one point. I served on a congressional commission that you put me on to prevent WMD proliferation and terrorism. And one of the things we unanimously, bipartisan supported was we should discourage the use of financial incentives to promote nuclear power. And the reason why isn't because of problems here, but because you lose your moral authority to talk to countries like Iran, who, after all, point to us and say, ubi est mea, we'll do the same. You want to subsidize, so do we. Who cares if it's economic? I think we should care.
Well, to clarify, we're not opposed to these loan guarantees. We're supportive of a fully functioning Title 17 loan guarantee program. Mm-hmm. Now, I think there are some characteristics that we should look at to judge whether or not a loan guarantee is effective. First, does it address a market failure? In that case, we can look further. Then we want to look at exploring technologies and promoting technologies that provide clean, cost-efficient, and safe energy to American consumers. There are potentially some instances where nuclear programs meet those criteria. There are certainly instances where wind and solar meet those criteria, and other technologies meet those criteria.
Title 17 has 10 very broad categories of technologies are eligible. If you implement the program under 1702B2, which is the borrower pay provision, it's actually technology neutral in the sense that you don't have to allocate scarce federal dollars to any particular technology, and it's more a function of how long does it take the technology to get into general use, which is then the...
Well, but we have other subsidies I mean, we have the tax credit available for the ethanol industry. We have other ways that taxpayers finance other forms of energy.
Sure, sure.
And you are supportive of, you agree with that or opposed to that?
About Title 17.
We had the privilege of testifying, my boss, in front of your colleagues, the Ways and Means Committee, last week on fiscal policy as to, I think it was the green economy expansion. And while we certainly support fiscal policy as one of the tools, I mean, we do have to take into account where we are in an entire economic perspective, which is right now we are running record deficits and project to do so for some time. And there are things, much like concessionary financing, like loan guarantees, as well as perhaps the seated proposal that both the House and the Senate have looked at, in addition to, as was mentioned in the previous panel, regulatory reform that can be done without any taxpayer dollars. And I think that is especially in this resource-constrained environment where Congress should be looking.
Good. Thank you. Thank you.
We're just going to go for a few more questions.
Yeah, go fire away, brother.
Okay. Thank you, Mr. Jordan, for participating. For Mr. Caperton and Mr. Scott, hypothetical, if there's a default in one of the loan guarantees relating to the construction of a nuclear power plant, such as, may be caused by weak natural gas prices, the market falls apart. Could that indicate a greater likelihood that a default will occur in one of or more of the others? In other words, possible defaults may not be independent results. Instead, they may be interdependent on the overall, on energy markets.
I'm not quite sure if I follow
Okay, we've established in the last panel that that the Energy Information Agency says there's going to be weak natural gas prices for decades, relatively weak. That is, do fluctuations in the larger energy environment create consequences for these investments in nuclear power plants that, that actually establish a relationship between the investment in those plants and the larger energy markets? Is this something that people should take heed of?
I think that I want to make sure I answer your question. The two nuclear reactors aren't necessarily connected, and a default in one shouldn't necessarily affect a default risk in another one. The underlying economics of energy markets, in this case, low natural gas prices, could certainly affect all sorts of nuclear reactors. So I would think that what causes a default in one could very well be indicative of what might cause a default in another, but the default themselves likely don't cause each other.
Mr. Kucinich,
yes.
Let me try that, because I actually looked at that in the case of Florida at the Public Utility Commission. And if you looked at the moment when they made the decision to issue a certificate of need, there were a key series of assumptions the utility made to justify the economics of the plant. In the ensuing 2 years, 3 of the most fundamental assumptions changed dramatically. The cost of the plant went up, the cost of natural gas went down, and the phenomenal load growth projection evaporated. The utility now sitting there, having committed to the plant, spending hundreds of millions of dollars, now is faced with a whole new set of economic conditions. And in order to justify continuing with this project, they begin to change their 10-year plan. They start pulling out natural gas plants because they don't need them anymore to make room for the nuclear plant, whose economics has been undermined. They launch a campaign to oppose energy efficiency and reduce it in the integrated resource plan to make room for the nuclear reactor. So in a 2-year period, the economics changes dramatically. And of course, some people will say, well, we're doing this for 20 or 30 years. But in a time of uncertainty, the one thing you want in your investment portfolio is flexibility.
Well, but in terms of energy flexibility, I just want, we have to, do we also, of necessity, have to factor in the time it takes to put an energy facility online, well, so that it melds into the overall energy supply?
If you look at the case of Florida, the projected date when they thought they would need the reactor was 2017. When you bring in the change in demand, if you actually look at climate legislation, that same peak would not have occurred for 20 years. That means that what you want to do is wait before you commit to this massive project. A prudent decision that says, wait, I can wait for 5 years. I can wait for 10 years. And as a prudent investor, you want things in your portfolio that give you that opportunity. And so the inherent nature of these projects with their long lead time raises their cost of capital, raises their risk, and has exactly the effect, and natural gas has exactly the effect that you suggest. So
well, I'm looking at independent variables here. For example, new technologies come in. I mean, it was the last year the wind, American Wind Energy Association has said that they've added about 10,000 megawatts of new wind generating capacity in a year. Some say, well, that's the equivalent of 10 nuclear power plants. That's an independent variable that changes markets, okay? In the meantime, if you can move a new technology in, then you have other technologies that won't move as quickly in because of the capital intensive nature and the time that it takes to build a plant, and let alone repair a plant that might have a problem. So I just wondered, in terms of the totality of energy markets and the variables that you have to consider does that start to drive the risk factors of some technologies as opposed to others? In this case, we're talking nuclear. Anybody else want to try?
Mr. Chairman, yeah, I think,
Mr. Good?
yes, it certainly does, which is why you don't see any utilities right now rushing out to build a reactor. It is still very uncertain. And I think it cannot be overstated that at the end of the day, the risk that is placed upon these individual companies is so significant that they are not going to rush into it, as has effectively been implied, willy-nilly, unless they know the demand is going to be there. Obviously, the economic situation over the last 2 years has changed the entire energy landscape for the near term, but we still have significant projections in electricity demand in this country and certainly around the world. And just to make one point about your the EIA natural gas projections, I think it's important to understand what EIA does and what EIA doesn't do. EIA does not model based on any assumptions that are not currently in law, which is to say they're limited by rule, by congressional rule, as to what they can assume. Therefore, they're going to assume that every single tax credit that exists is going to grandfather out because the law says so, that every single subsidy is going to grandfather out, which is to say that I think you look at where Wall Street money is going right now and where investment money, it's going into natural gas. It's not going not going into natural gas, and it's going in there because they expect prices to increase.
You know, you raise a question about you know, why Wall Street's not rushing in right now. And it gets into this a potential of the moral hazard discussion that we had on bailouts. Now, Mr. Jordan and I both voted against the bailout. And if Wall Street looks at the risk factors here and just says, no, you know, we don't really want to go there right now. I mean, I will tell you, in the Cleveland area, we had a company by the name of the Cleveland Electric Illuminating Company, which was a top-rated company, blue-chip stock. They bought into nuclear power, and it wasn't too long, you know, within a decade or so, they started to run into serious financial trouble. Wall Street isn't taking the risk. So what we're doing, the risk factors that are laid out here today are essentially being taken up by the taxpayers. Now, whether you're for nuclear power or not, we're just talking economics here. They're being taken by the taxpayers in a constantly changing energy environment. New technologies being brought on, old ones starting to, you know, either get renewed, you know, energy drilling policy or the energy bill that passed. You know, that's why this issue of transparency, the issue of trying to figure out what the government's exposure might be, is not a small matter in a climate where everyone wants to know how much something's going to cost. Can we make some reasonable projections? What's our exposure here? Anybody else want to comment on that before I move on to something?
Yeah, Mr. Chairman,
Mr. Scott.
All of the factors that you raised, whether it's natural gas prices or other competing technologies, end up being evaluated both by the project sponsors, by DOE, by OMB, by the rating agencies. And, you know, practically speaking, the agency may have views on assumptions about electricity prices or gas prices that are different than a project sponsors, and ultimately gets reflected in the underwriting of the project. Now, they may or may not be right. The companies may not be right. The government may not be right. But you fast forward when, in particular around nuclear, if you think about when a loan guarantee would actually close, because they have to meet the conditions precedent, you remain 2 to 3 years away before you're going to see an actual closing. And it's the assumptions at that closing time that are going to be relevant to the evaluation of the business plan, both by the rating agency as well as by OMB on the credit subsidy side. So at the end of the day, you end up with the best information that you have when you need to make that decision and when you're actually exposing the taxpayer on the federal loan guarantees.
You know, it's interesting because, you know, the familiar anchor points which we have to try to come to a level of analysis that would say, well, this is our best estimate. we've started to see in the last couple of years some changes in the status. You mentioned credit rating agencies, okay? You look at the credit default swaps and some of the information that credit rating agencies really had a responsibility to disclose, but they were in a conflict. We see the latest Abacus case involving Goldman Sachs. Credit rating agencies again come into play with raising questions about the information they're providing to the public. We see that shareholders not being given information they were entitled to, they didn't get it, lack of transparency. We see even in this environment, Congress having trouble fighting for a bill that would bring about financial reform and bring a new measure of transparency. So in that kind of an environment, you have to forgive this chairman for being a little bit cautious about how much more of an exposure in a highly risk-filled environment we want to provide for the taxpayers. That's why this is a very important discussion, because I looked at your resume, Mr. Scott. You have been as much as anybody, over all of these issues related to credit availability, credit guarantees. I happen to believe that there are some cases in which that it's an appropriate role. I think that R&D in particular is a great place that we could incentivize all kinds of possibilities for the government to start things happening. But when we instead of buying a few implements, we buy the farm. It starts to become a little bit more problematic. And I want to thank each of you for being here today. We've had excuse me, Mr. Cummings. Thanks for joining us. Do you have any questions?
Mr. Chairman, I thank you for calling the hearing. And I have my questions for the record.
I appreciate that. The members of the committee have 5 legislative days in which to submit questions, and I would ask the members of the panel and the previous panel to please be available to respond in writing to any questions that members may have. Again, very impressive panel. You've really given all of us in Congress a lot to think about here. We'll make sure that your testimony gets widely distributed. This is the Domestic Policy Subcommittee of Government Oversight and Reform. This committee has been about nuclear loan guarantees. We'll probably have 1 or 2 more hearings on this. This committee stands adjourned. Thank you.
The Time Bandits the first to catch their share of the crab. But Sig and his Northwestern topped the fleet, catching the most crab since the season began.
Don't miss the new hit series, Construction Intervention. Walter! Charlie Fortini's giving the little guys a second chance.
I'm gonna give you all I got.
Tonight, Charlie helps a New York firefighter dish out some heat and rescue his hot wing joint.
People were walking out the door. He was losing business.
To shut it down was the hardest thing for me to do.
This is a big deal for this job.
Now we're going to get those doors to stay open for you. That's what I'm here for.
Construction Intervention continues tonight at 10. It's all new on Discovery.
Ever wonder what it would be like to have monsters and aliens invade your home? We did. Introducing a new dimension in television. Samsung 3D TV. The world's first 3D LED TV. That's the wonder of Samsung. Get a free 3D movie and 2 pair of active glasses when you buy a Samsung 3D TV and Blu-ray player.
Morning.
Got in pretty late last night.
Dad, I'm not 16 anymore.
Still, it was late.
Well, you're not going to have to worry about that anymore.
Yeah, why's that? Todd's a lucky man.
The best part of waking up
That's what I told him when we talked last week.
is Folgers in your cup.
Right now, all over the country, Discover Card customers are getting 5% cashback bonus at home improvement stores. It pays to get more. It pays to Discover.
There's one reason why over the past 100 years, generations of men have trusted Gillette. When it comes to shaving, we've given them our best. And on June 6th, we'll give them something even better.
Compare deals from hundreds of travel sites at once. It's kind of like speed dating, but you can skip straight to the more attractive options. Kayak. Search one and done.
Hey, losers! Start in 3 days.
It's pretty much a suicide mission.
Good times. Losing. Kill him. He's not an option. Hit it.
That was my ride.
Bummer. Rated PG-13.
You made this season's premiere of Deadliest Catch the highest rated episode in series history, and we're just getting started. Tonight, low numbers and close calls prey on last nerves.
I'm trying to be nice. Sorry, I'm a little upset. You're not upset. I know you're out of here.
But a good haul has some riding high. The new season of Deadliest Catch continues tonight at 9, only on Discovery.
220 miles northeast of Dutch Harbor, the Rollo is going full speed ahead, but the coffee is at half ration. The sleepwalking crew, working non-stop for 18 hours, has lost count of the pots, when suddenly... the horn goes off, indicating the last pot of the season.
We're going home. Going home, man.
It was a real good season. Eric did a hell of a job as always. Found a hell of a lot of crab at the end there.
Yeah, I'm happy. I hope we get it done, get the hell out of town, get my paycheck and go home.
Last crab.
Going in the tank. He's a beauty.
Woo! 50-5-0-50. That's it. Heading back to the barn. Feels good, man.
The Rollo caught its quota of 103,000 pounds, which means a good paycheck for the crew. And there's one pot of coffee left. All around the fishing grounds, crab boats are sorting the last of their catch and securing gear in preparation for the 200-mile run back to Dutch Harbor. The Maverick has reached Dutch Harbor. After his final weigh-in for the season, Captain Rick Kwasnick has good news to report.
Crabs are great, virtually no dead crab. The crab gods were shining on us. 100 pounds of dead crab out of almost 100,000 pounds of crab. It just doesn't get any better.
In the galley, would-be Captain Blake Painter tries to stay positive after a big disappointment.
I got an ex-girlfriend that wants to make love to me. I'm styling.
Happy camper.
Just made a buttload of money.
You ride on the boat for the whole piece?
I hope so.
The boats are weighing in, cashing out, and heading home to loved ones.
We're done with our last brailer off. Good thing, man. 103,095 pounds of love.
Because of their enormous quotas, the big boys, Sig Hansen's Northwestern and Phil Harris's Cornelia Marie, are the last to finish fishing.
This is the last one. We're going to take off and go unload the stuff.
It's the last part of the season here. We're going to let Jake throw the hook here, and we'll see how he does.
Jake gets the line on his first toss. A good sign for a young fisherman.
That's the last one, fellas. Thanks for the nice trip. You guys did a good job. Damn, there's some keepers now, too.
Threw the hook for the last pot there, and we need a lot of practice, but hopefully the guys will give me a lot more time there here in the near future.
380,000 pounds of king crab caught. Everybody wants to go home to their family and see their wives and children and relax for a while.
As the king crab season comes to an end, Captain Phil sits down with Jake the Greenhorn to discuss the future.
I don't let anybody that is just starting out take watches. You're a little bit different case. I think it's time that you do start taking watches. So OP season will start doing that. You've earned the right to be up there, so.
I think that'd be a good thing.
Better.
You know what? Got to start somewhere.
That's it.